All right, and welcome to the beginning of this full over 3 hour course on how to trade, specifically how to swing trade, right? Now, we are going to go over literally everything. Like I said in the introduction, everything, all right? Now, not only do you have all the way from the beginning where you don't even know anything, right? The basics of trading, just trading, not even swing trading, just trading, all the way to the most complex things you can think about when it comes to trading, like setting up the proper risk management or the strategy, the psychology part of it too. It gets pretty in depth and it gets pretty complex, and some would even say difficult. So that's why it's always at the end. Okay, so let's just go from the basics, right? If you don't know anything about trading, this is where you should start, and this is where you should start taking notes, right? Everything I'm saying, just pause the video, take notes, because when you write stuff down, right? When you're writing it, it just makes it better. That's a big part of it as well with trading, which we're going to go later on. It's writing things down, right? Because when you write things down, it just sticks with you easier, not just hearing it. And that works for everyone, right? So make sure you have notes down. You're pausing the video if you need to and writing down what I'm trying to say, and then we'll get it. It should be easy for you guys. You should know how to trade in maybe, I would say, like a month or two of like just knowing what trading is and the basics of it, and how would go about trading it. I would say it should all become pretty simple to you in the next coming months or so if you actually give it time to learn, right? But before we go into what is trading, I want to kind of explain to you what we're looking for here, kind of like a checklist, right? So this is the Millionaire Trader checklist, all right? It's what you should do. If you can do all of these, make sure if you can literally print this out or whatever, write it down. Make this checklist. If you can complete all of this, you're good. You're on your way to becoming a profitable day trader or swing trader or whatever kind of trader you are, okay? So for the one thing is the basics. You got to learn the basics. If you don't know the basics, and then you're literally setting yourself up for a complete failure, right? If you skip this, you just try to go for all these things, try to find a strategy where you don't even know what fucking trading is, you're screwed. It's over for you, right? Trust me. It comes from experience, all right? People want to try to find the easy way out, and that's not a bad thing to do. I try to find the easy way out on a lot of things, but one thing you have to understand is when it comes to trading and being profitable and actually trying to make money, this is something you need to know, okay? Basics. Learn the basics. This is what we're doing. Technical analysis. Learn what technical analysis is. Learn how to analyze the market for what it is, not what you think it is, all right? And we'll go over that later, okay? It's very important that you learn the technical side of trading, all right? Strategy. You got to find a strategy. I will show you my strategy. It has over an 80% win rate. Take it if you want it, or find any other strategy, all right? Whatever strategy that you know is profitable and has a good win rate, use it, and then maybe tweak it or do whatever. Back test it. That's the next one, all right? So after you find that strategy, back test that strategy like a motherfucker. You have to see if this strategy is actually good for you, right? I don't just tell you, right? I don't tell you when you see my strategy, when you learn my strategy, to just use it and just believe me, right? Don't just use it and believe me. Use it on a back test, paper trade it over a series of hundreds of trades. See how well it goes for you. 80% win rate and above, all right? Just know back testing is very important to find out how good your strategy actually is, right? What your win percentage is. Optimization. When you backtest your strategy, there's going to be a lot of flaws and tweaks. Even if I show you my strategy, you're a different trader than I am. You're a different person. It's always going to have some things that are different from me and from you, even if we're using the same strategy. That's why optimizing is really great. If you find a tweak in the strategy or whatever strategy you have, and because you backtest it countless of times, hundreds of times, optimize it now. Those little tweaks make it better, perfect it. After you optimize your strategy, next thing you do is risk management. You have to find the right kind of risk appropriate to your strategy and how you are as a trader, how you're going about as a trader. Some people, it really depends on what you trade too, right? You're a scalper, a day trader, swing trader, your risk is going to be different, right? What kind of person you are, how many trades you take a day, your risk is going to be different. So find the correct risk management plan for you. We'll go over that. I'll tell you my risk management plan. If you don't like it, I will also tell you how to find your own and how to do your own, okay? Another thing is paper trade, right? Paper trade like a motherfucker. It's different than back testing, and we will go over that in just a second, but I can give you the gist of it now. Backtesting means you're kind of going a historical pattern out, right? And it's pretty simple. Backtesting is just going back in time from the previous market, previous charts, previous historical charts, and backtesting that strategy to see how effective it is back in time, back in history, market history that's not in the present, all right? Paper trade is just the present. You're paper trading, you're not backtesting, you're paper trading your strategy and the present market, how the current condition is now. And this is way better than backtesting. You're just backtesting to see the profitability of your strategy over the course of the overall market. But this is the present time. That's why you're paper trading, because once you've optimized your strategy, once you find a correct risk management plan, that's the whole thing. Once you find a correct risk management plan, then you'll paper trade. You'll paper trade. This is literally will be exactly like you're trading real money, but it's not, right? So if I'm sitting in the charts right now and I'm trading, that is paper trading, all right? You have everything you need except the discipline and the emotion side of it. That's where paper trading comes in, because once you're good with paper trading, once you're profitable with paper trading, you have the discipline. All right, you have the discipline to get into a real life account, and that's when it gets a little different, and we'll go over that at the end once you're actually able to get into trading, like trade real money. We'll get into that because it's a whole different market. But right now, you are a beginner. You know nothing about trading. Basically, this is what you need to know. This is the millionaire checklist. Millionaire checklist. Check every box after we go through this entire course. Make sure you come back, check that box. I learned the basics of trading. I learned the technical analysis part of it, the technical side of trading. I learned the strategy, what strategy I'm going to use. Backtest, optimization, risk management plan, tech. Paper trade, check. I'm profitable in paper trading. Then I got the discipline, check. Real account, let's go. That's a different story, different ball game. We'll get into that later. Now we start. What is trading? Before you move on to the next, before I move on to the next slide, tell me basically in your mind, ask yourself what is trading and try to answer that for you if you don't know anything about trading, right? In the simplest terms, it's pretty easy to understand, okay? We are basically buying and selling things, all right? That's what trading is. We're buying and selling, all right? There's always a buyer and a seller in any transaction, okay? Both parties are trying to benefit from that deal, right? From the buying and selling. So as a trader, as any kind of trader, we're trying to profit off of anything that we're doing in the market, any buying or selling that we're doing in the market, all right? Now, what buying is, so the simple thing in thinking of buying and trading is going along, right? Because when you're buying, you're wanting to think that price is going to continue going up. That's why you're going along with it. You're going along with it, right? So if you buy, let's say right here in the lows of this arrow at the end, and then it goes all the way to the top because you bought here, think of it like that. Think of you're going along with the buy, right? You're going along. So you simply buy at a certain price. Let's say this is price X, all right, and you hold onto your position. You do this because, again, you think the market is going to go up, right? You think it's going to rise because you have bought as well. And if that happens, you can sell at Y, price Y, and make a good profit, okay? That is what buying is. It's very simple. You're just buying things to wait for the price to go up, all right? Selling. Now, as traders, all right, we can also profit from selling. It's a little different here, okay, but it's also called going short, right? Because you're short, you're going down, right? As a short person, you should know this, down. And as it is called in trading, that's what short is, going short. We can also profit off this, right? When we short the market, we're going to enter into an agreement, right, with another party. We say that we're going to sell them something at a current price, right? And sometime in the future, we're going to sell them that at the current price sometime in the future. So no matter what the price does, we're going to sell them at the future at this current price right now. And if they agree, right, in their mind, they think they're protecting themselves, basically, all right? So they think if the market is going to increase in price and they want to buy at the current price, that's good, right? But however, for them it's good, but for you it's bad. But the reason why you're selling is because you believe that the market is going to fall. That's why you're trying to sell at the current price. Do you understand? Because if that makes sense. So let's say the market does fall, like you said, and you can buy at a lower price. Say we put like £5 or $5, whatever you go by. You already agreed to sell to the party, right? The previous party beforehand, the person you were agreeing to sell at the current price. They paid $10. They all paid £10, $10. You basically fulfill the agreement because price went down, but you agreed that you would sell them at the current price, and you net literally a $5 profit. That is what selling or shorting the market. That's how you make money trying to sell the market. This is a little more complex than just buying, because when you're buying, you're expecting the price to go up and you make money. So what? Short is you're expecting the price to fall down, right? And we can say that we're going to sell to someone, like I'm going to sell to you at the current price right now, sometime in the future. Okay, a certain expiration date. Let's give it a month, right? A month out, I'm going to do that. Price goes down in a month. You sell them at the current price, you made a pretty good profit. That's what selling or shorting is. Pretty simple. Now, there are a lot of other reasons, people are trading, or people buying and selling, right? You have banks, companies, pension funds, hedge funds, so many things, right? They all are involved in the financial markets. So for us retail traders, all right, that is the main component we need to understand. All of that, right? All of that is a main component you need to understand what buying and selling basically is. It's the main component. Why? Because these motherfuckers right here, right? Banks, companies, pension funds, hedge funds, investors, these billionaires, they all control the market. They're all involved in financial markets. That's the reason. They have many reasons to why they buy and sell, to control the market. We just have two. Is the price going up or is the price going down, and how can we benefit from it? That's it, right? We're retail traders. We don't have billions of dollars to make the market move. We can't control the market, but we can benefit from it, right? That's the main thing you need to understand with trading is you're not trying to move the market. You're trying to follow the wave, right? So to speak. Market behavior. So the price, when it comes to price action, it kind of reflects your psychology as a trader, all right? Look at every candle telling a story, right? Of either aggression, hesitation, some way, in some form, there's always some aggression or hesitation, right? That candle is telling a story, but it doesn't mean it's the full story, but it is telling a story, okay? So volume confirms a conviction, right? Rising volumes during an upswing signals a very strong buyers. There's very strong buyer interest, okay? And then if you look at, let's say, sellers, right? Volume rising with sellers when it's on a downswing, right? When it's going down, that signals strong sellers. So volume confirms conviction, right? It gives you a good conviction. It gives you good bias. Price action tells a story, right? Every little candle, I'm going to tell you exactly what candles are. They're telling you a story, okay? Now, the other thing, is structure defines the market direction. What structure means is that in a chart, you're looking at charts, we'll show you one in a second, higher highs or higher lows indicate uptrends or downtrends, right? And I'll tell you exactly how that works when I show you the chart, right? If you don't understand now, but just a higher high, you have one high, another high, that signals an uptrend. You have a lower high, right? One right here, that signals a downtrend, right? Pretty simple, but we'll show you exactly what that means on the chart. But there's a little assignment that I want you to do, all right? I want you to go through 10 charts. You don't have to do this now. If you want to pause and you want to do this, go through like 5 or 10 charts, go ahead. Go through 10 charts and label the current market structure, right? Is it an uptrend? Is it a downtrend? Or is it consolidating, all right? Because it might be consolidating. And what consolidating is, it's pretty simple. Again, neutral, right? There's no higher highs. There's no higher lows. Bounce here. We have another low here. It bounces right back. It bounces right back to this high. So that's consolidation. Go through that without you knowing anything about. I'm not going to show you the chart of actual chart of the trends at all. Without you knowing any of that, just go through 10 charts. Just look up TradingView, find charts, or just look up multiple charts on Google or whatever. Go through 10 charts and label the current market structure. Okay, do that. See how you do. You might do well, you might not, but that doesn't matter because you'll know how to do it after this video. The candlesticks. Right, candlesticks are very important. They are either bullish or bearish or neutral. All right, and that's what we'll explain in right here. Okay, so when it comes to bullish candles, you have green. Right, most of the time you'll see in a chart you have green candles, but you can always change it. But the most common one is green. And when it comes to a bearish candle, it's red. Bullish means it's a buy candle. It's a good, strong buyer confirmed candle. Bearish is just a red candle. It's selling candle, right? Sellers are in control in this candle. The green buyers are in control in the candle, right? And what you have here, pretty simple: open and a close. So what that means is this candle, each candle has a certain time, like a certain time limit, right? And just look at the clock, right? You see like the 1 to 5s, all of that. Each candle of that can either mean a minute, a second, right? Like an hour, stuff like that, right? Think about it like that. Each candle can either mean 5 minutes, 30 minutes, an hour, 4 hours, depending on the time frame. But let's say this time frame right now is 5 minutes, right? That means that this candle, for it to be bullish, for it to be strong with buyers, full with buyers, it has to close above its open, right? So the candle opened right here. This is the price. Candle opened right here at this price. Let's say it's 1, right? This is the lowest this candle has gone to in these 5 minutes. This candle its time span is 5 minutes. It's going to close in 5 minutes. As soon as it opened, right? This is where it opened. This is the price it opened. This is the price it got to at its lowest, right? But why isn't it full here, right? Why isn't it full? There's a reason for that. Because where it closes after the 5 minutes, because it's on a timer, remember, 5 minutes starts, once 5 minute ends, it closes somewhere. For a strong buying candle, the price has to close at that 5 minutes above the open, right? But that doesn't mean price hasn't gone places, during that. Price went at its lowest right here. Price went at its highest at the top. But it didn't close at the lowest and it didn't close at the top, right? It closed right here. So this is where price closed. This is where price got to at the highest, and this is where price got to at the lowest, and this was where price opened, and this was all the movement that was going in from between the close and the open, okay? Pretty simple here. That's what it's telling you. It's telling you a story. But you have here, it's just the reverse, okay? It's just the reverse when it comes to the open and close. Why? Because for it to be a good, strong buying candle, it has to close above the open. But for it to be a good, strong selling candle, it has to close below the open, okay? So it opened here at 5 minutes starts, opened here. Price went places, right? This was the highest price went. This was the lowest price went. That's the same with the green candle. But this is the highest. This is the lowest. But at that 5 minute mark, price closed right here. Closed below the open, closed right here. And this was where all the action happened between the open and the close, okay? Pretty simple, all right? Buying candle, if it's a buying candle, if it's a green candle, closed above the open. And if it's a red candle, if it's a selling candle, closed below the open, all right? And this one closed above the open. I don't remember if I switched that up. So above the open close and below the open close. These are some of the candlesticks that you're seeing here. You're going to look at me and say, are candlesticks actually good? I know a lot of you have said stuff like that. Don't look at the names. Don't look at the names of the candlesticks, all right? Because at the end of the day, the names are basically telling, it's just shit, all right? It's basically it's showing. People think it's so stupid because people have made these names with it, but it's these candles do tell you a story, right? You don't use them for actual kind of confirmation, but they're telling you a story, and it's good to know, right? So a lot of these things, it's just unnecessary, right? There's only really, in reality, only 1 or 2 things you need to know, and the most important one is this, the doji candle. This is a neutral candle. Like I said at the beginning, when we came to the side, there's a bullish candle, a bearish candle, and a neutral candle, right? Where there's literally no color. You see on these candlesticks, no color. This means that price was pretty neutral, consolidated price at that time, right? A 5 minute time frame. Remember, price opened and closed at the same time, at the same place, basically. That's showing that buyers and sellers, one of them couldn't beat out the other, right? They were pretty much kind of agreeing in price, so to say. So one of them couldn't beat the other, and that's where it ended. This can help tell a pretty big story. All right, it can, and we will go into that later in this video, but it can tell you a pretty big story of a good confirmation, all right, and have good confirmation. Everything else, not really as strong confirmation, but it does tell you kind of a story, right? And as you can see here, a hammer candle, green candle, but it closed, the open was pretty high and the close was above too, right? It didn't have really high pressure. That sells a pretty good strong candle on the green, on the buy side, right? Just reverse, price opened, but closed, but opened pretty low, right, at that time, and closed again low. It didn't have any highs after that. It didn't go through any highs. It closed at its highest. That's basically, it's called a shooting star, but fuck the name. All right, it's just showing you that sellers are pretty strong. Okay, so not many candlesticks. You got to know the most important one is the doji candle. Oops, doji candle, and a bullish and a bearish candle like those. All right, pretty simple. The forex trading market. What is forex? That's something that most of you are going to be trading is forex. It's the biggest, most liquid market there is. So the forex trading market is an international, it's a decentralized financial market where one currency is exchanged for another currency, okay? So it's, like I said, the most largest and most liquid market in the world, all right? It's literally trillions of dollars being traded in currency, basically, okay? So because it includes all the currencies in the world that we so seem, necessary to put in there, all right? And you can see it's kind of like referred or referenced to as like just forex or FX, spot FX, or mostly just spot, you see. But yeah, at the end of the day, in historical times, only these big investors, big institutions, big corporations, big hedge funds, they all were the ones that had the resources to participate in the forex market. But things change, right? It's the modern world, and it's very popular now because we have good technology, okay? So it is possible for us, average investors, even though I make millions of dollars in this, I'm still an average investor compared to the big people, the big guys, the big players, all right? But we're still able to buy and sell currencies with the click of a mouse from the comfort right here of our own home, all right? So the factors that can affect the value of the currencies, either if it increases or decreases, are the supply and demand of these currencies, of these two specific currencies put together, right? That will be involved in the conversion process of, how you're looking at the forex market, right? So understand that everything's different, right? All of these currencies converse in a different way. You have like euro dollars to USD, yen to USD, Canadian dollars to USD, all that kind of stuff. You have different types of conversions because you have different types of currencies. You know what I mean? So yeah, that's how forex is, right? You don't have to understand any more than that of what it actually is. Basically, the most important thing is seeing what it's called, because you're going to see a lot of these different things. That's all means forex, basically. Okay. But yeah, let's see the brokers that you want to choose. Okay, depending on where you are, some of these brokers you're not able to trade, right? I know Charles Schwab, I'm pretty sure that doesn't work in the UK if you are in the UK, but it works a lot of other places. Awanda is a great forex for forex trading too. Forex.com, another great broker. Charles Schwab, another great broker. I have one from Charles Schwab and one from forex.com. Right? So depending on where you are, I would look at your country to say, oh, these are the main big ones, right? So if you are looking at ones, I would definitely look at these three, see if at least one of them is in there for you. If not, then try to find one that's regulated in your country, right, that you can do. But yeah, these are mainly the brokers, and it's important to choose a good regulated one, but it doesn't matter which one you choose. Now, market sessions. I have marked these out in GMT time. You have obviously different times that you can trade, but at the end of the day, just find out how to convert your time to their time. It's pretty simple. You can even find your own time zone market sessions if you just go on Google too. But you have 4 sessions: the New York session, the London session, the Tokyo session, and the Sydney session, okay? I mostly trade the New York session or the London session when I get into my trades. I don't mess with the Tokyo session. I don't mess with the Sydney session. It's up to you. It's up to where you are. It's up to a lot of things. It's up to what time you want to wake up and trade this, which session you want to trade. Literally, there's so many factors that go into it, right? I know that the most volatile one, liquid one, is the New York session, followed by the London session, I believe. That's just because of the fact that the New York stock market opens at this time, right? So yeah, if whichever one you want to trade, most of you are going to trade definitely the New York or the London session. Go ahead, okay? But yeah, I trade mostly these two, New York and the London session. Now, there is a thing called leverage, which is why we're able to trade in such a small amount of money, right? You don't have to have billions of dollars to trade anymore because of leverage. So in finance, leverage just refers to borrowing money to supplement the existing funds for investment. So it's such a way that there's a very positive or negative, I guess too, you can say, outcome, and it's either magnified or it's enhanced, all right? So it's the amount of leverage on your account. It really determines the amount of funds that you need to put up for a trade. And it either depends on a lot of whatever you're trading, like indices you're trading too, forex, futures, all that kind of stuff. It really depends on what kind of leverage you have there. Now, leverage gives you, like a trader, the ability to trade large amounts of currency with a very small deposit, okay? And it's a good thing because when you don't have a lot of money to trade, leverage is your friend, okay? So let's say you have a $200 deposit with the leverage of 1 to 500. That will allow you to trade $10,000 worth of cryptocurrency with only a $200 deposit. That is insane. That's why leverage is such a good thing. That's also why in some countries it's well regulated, like the US. You can't have more leverage in terms of forex than a 1 to 50, all right? That is because leverage can leverage can either destroy you or make it big, right? That's why it's so regulated, because in countries, especially like the US, where the New York stock market is open, it's so vitally important, all right? So understand that leverage does not always mean good. Sure, you can make shit ton of money with not that much of a deposit on your account, but you can also lose stuff just like that, all right? So I guess if you don't care, go ahead, okay? But still, I wouldn't recommend you be that much of an idiot, unless you have a shit ton of money to spend and to just play around. But sometimes I like to do challenges like this, and I use a pretty big leverage because I have overseas brokerage accounts. But sometimes I don't, right? So most of the time I have leverages of around, I would say, 1 to 30 to 1 to 50, like the US regulation deems it so, okay? And that's not bad when you have a good amount in your account. But at the end of the day, it's always best to start with lower leverage and just kind of perfect and master the strategy and you as a trader, right? Not trying to beat the market by putting an insane inflated amount of leverage, all right? But that's why leverage is good. Leverage is a good thing. That's why we're able to trade with such low amount of money. Other than having billions of dollars and trying to move the market, we can use leverage and then we can follow the market, okay? And it always depends on how much you have to put up for a trade. Margin, all right? That's necessary, right? Margin is the necessary amount you need to have in your trading account in order to open any transaction, okay? So free margin is basically the available amount of money that you have in your account, all right? Which can be used to open any position, any new position, okay? And you look at leverage as 1 divided by the margin, or you look at margin as 1 divided by the leverage, okay? Now, what is a pip? When it comes to currencies, it's a very big thing. It's showing you exactly where the point in percentage is. Now, you can relate to the smallest, pip can relate to the smallest price movement any exchange rate can make, all right? And it's kind of like a point for calculating the profits and the losses of your trade. Now, pips can usually differ, but most of the time it's the last decimal place of your quotation, right? Of the price that you see in the prices in the charts when you look at your currencies. You have the amount of pips it can go down. It's usually the last decimal place of the price, right? Most pairs go up to 4 decimal places, but there are some, like the yen, that go out to 2 decimal places, okay? So the exceptions will include the yen, right? That's the second decimal, 0.01, right? And then you have the third decimal. I'm not sure what currency this is, the Czech currency, but that's the third decimal of 0.001. Okay, you're not really gonna trade these except the yen, so it doesn't matter. Okay, it doesn't really matter. You're trying to find, if you are trading forex, a couple of currencies. Don't go too big. Don't start trading a lot of them. Trade the most popular, most liquid ones. You have the euro, you have the pound, the USD, Australian dollar, Canadian dollar. Trade those. Okay. Now, there are brokers that quote currency pairs beyond the standard 4 and 2 decimal places to like 5 and 3 decimal places. So depending on the broker, always make sure, this is why I put it here, always make sure that you're finding what kind of broker you have and how they do their thing, all right? Because it's all different, right? They're quoting fractional pips, which are pipettes, right? To understand that some brokers do it differently. That's why I put it here, so you can actually write this on your notes, know and remember to check how your broker works around pips, okay? Because all of them are different in some way. Types of trading, all right? 3 types of trading that I implemented. There are some more, but these are the 3 biggest ones. Day trading, which most of you know is getting to be a popular thing. I'm not really that much of a fan of it when it comes to doing it for a long time, but it's called intraday trading, right? Open and closes a position on the same day. That is day trading, all right? Day, intraday, closing position on the same day, swing trading, or day trading. Swing trading, my bread and butter, keeps positions for a few days or weeks to catch medium term or medium to long term trends, okay? Swing trading is the best. I say that, I am biased about it, but it's so nice to just go and take a couple trades a week, maybe even one trade a week, and just be done with it, not having to go and look at the market the whole time. I can live my life. I can work on my other things that I have to work in. I have a lot of other companies that I'm in, real estate also, that I got to check on, properties. I can do all of that with swing trading, and that's the only thing I can with swing trading. All right. Position trading though, I'm a position trader too. I like that as well. I'm into investments. I invest options, stocks, all that kind of stuff too. Long-term trading, right? So you're running at months, usually years, all right, to track the basically the broad economic theme or the broad economic history the future history that's gonna come, all right? So day trading, you're just taking a trade on the same day. If that's what you like doing, go ahead, do it. I don't think it's the best for you at the end of the day, because if you have, especially if you have like a 9 to 5, especially if you have other things you need to do, like take care of your children, or you have school, stuff like that, day trading probably isn't the best. Swing trading, you can get on your computers a couple times a week if you want to. I get on it every day because I love it, but you can a couple times a week. Take a trade, just watch it, set alerts, let it be, right? Position trading, same thing. Get on your laptop for like a little bit, invest, get into a long-term trade, wait months or years, set alerts, and you're good, right? Position trading, usually only when you have a good amount of money to get into it, right? So once you make a lot of money from swing trading, once you make consistent profitable money from swing trading or day trading, this is when you go to position trading or long-term trading, because it's just better, right? Because you're investing long term, you're able to put more money in these long term trades, and you're just kind of holding it, all right? So if you do have enough money to invest, that's when you invest, right? But if you don't, if you're just starting out, there's no point in investing. Swing trading, that is what we're doing. That is our bread and butter. Now, our main focus, again, is on swing trading, all right? And how you're going to capitalize on trades without having to take a trade every single day. I'm a one and done kind of person. I always say this. I put it on my motto in every single place on my social media, one and done. If I take one trade that hits that week, I am done that week. That is freedom. That is freedom, right? But sometimes I take 1 to 2 to 3 trades a week. Okay, but I'm not having to take it every single day. That's the good thing about it, right? You don't have to take a trade every single day. You can just set alerts, keep it right. When I take a trade, when I'm in a trade, when I'm in 2 trades, depending on how much money I size up, sometimes I go full size in 1 trade. I don't take any more. I still go in the market. I still analyze the market maybe for next week if I can find something, stuff like that. But I'm not taking any trades. I'm not that worried, okay? I have a stop. I have a take profit. I let it do its thing while it's in between those two, okay? Now, the target markets for what I trade, all right? These are my target markets, all right? This is what I'm trading. This is the only things I trade. If you trade different things, go ahead, but these are what we're going into, right? This is what, if you are my student or if you're going to learn with me, this is what I learn. This is what I teach, sorry. Forex, big market, most liquid market. Most of you are going to be trading Forex. Go ahead. Commodities. Pretty nice. They do well, right? And I'm actually the best when it comes to commodities. Gold and silver. That's my bread and butter, right? NASDAQ, right? S&P 500, NAS 100, US 30, even like Dow Jones, that can be something you trade too. But these 4 are what we're going to look at, all right? So Forex, commodities like silver and gold, NASDAQ, and then S&P 500, basically the top companies in the market, right, in the economy. So yeah, just look at these, try to understand what I taught you Forex just because it's the biggest, most liquid one. NASDAQ and S&P 500 just shows you the top top dog companies. Like S&P 500 shows you the top 500 companies in the economy or in the market, and then commodities, silver and gold, that kind of stuff, basically. Okay, so just understand those, and everything that you need to learn when it comes to the strategy, the risk management, can apply to anything, right? Even things that we're missing here, like futures, options, like all that kind of stuff, right? You can learn with the strategy and with anything, right? Because it all kind of ties up, but they have their different personalities. They're all just a little bit different in some way. You'll learn that through experience. What trading style best fits your lifestyle? You have to know yourself, I think, for this one too. You have a personality. Your personality, you will see how your personality fits when it comes to, I would say, what you trade, what trading style best fits your lifestyle. And we're only talking about day trading and swing trading, because position trading, you need to have a lot of money. If you're rich, then sure, we'll go into business trading too, right? But if you're not at the moment, you're still, kind of grinding it out. Let's not get into that one, all right? Know yourself. What kind of personality you have, right? Are you patient, right? Do you have patience? Or are you too, just eager to get into something? Like, or are you just, very ecstatic? Do you have ADD? Do you have OCD? That kind of stuff. Know your personality and see how well one of those fits you, right? Because if you're day trading, you have to be stuck on the market every day for an hour or 2 or 3 at least on end, looking at the market like this and trading every single day. Or, are you patient, right? Are you patient enough to do that? Are you patient enough to maybe to get into the market a couple times and just let it ride, not be too worried during the day because you're swing trading and you're not looking at the market because you're not supposed to all the time because then it's going to make you crazy. That kind of stuff. It all just depends on how you fit best into each trading style, right? Do you have especially time, right? Time requirement. Are you full of time? Are you free? Or are you really busy, right? Especially if you have a 9 to 5, school, work, something like that. You have a time stamp on your hand, right? You have a time limit. And day trading just might not be that thing, right? So swing trading, you can work. You can do whatever you want. You can literally be on your phone, set alerts being like, gold just hit my take profit, right? My target. I'm going to sell on my phone while I'm at work. Cool. You can do anything at school, just like that too. Go to the bathroom, it's like that. Simple, all right? Very simple. Now, also your education and your knowledge. They're all different things. If you have more education when it comes to like day trading and you don't really want to try to learn about swing trading, okay. But if you have more education about swing trading and not day trading, swing trading, if you don't know anything about anything, then you don't have to answer that one because you don't know anything about anything when it comes to trading. Account size. Do you have more of an account? Do you have less of an account? That used to matter. Now it doesn't really because leverage is a thing and you can even go in very small amounts to swing trade or day trade. So it doesn't really matter, all right? Also prop firms too. And if you want to do day trading prop firms, go ahead. But there's also prop firms that let you hold overnight so you can swing trade too. All right. Now, financial targets. What are you trading? Some targets are a little better when it comes to like what you're targeting to trade, how much money you want to make. That all depends a lot, used to depend a lot on, because when you didn't have like prop firms or that kind of leverage or something like that, it used to not be the case. But nowadays your targets can be the same for swing trading or day trading, but it's just depending on the biggest thing. Literally, you also have markets and instruments too, because you have like futures, which would be best for day trading, options, which would be pretty good for swing trading, forex, all in all, commodities basically same thing too with forex. You can do whatever. So the biggest and most important thing is the time requirement. All right. Are you busy or are you not? Even if you're not, you can still swing trade, but if you are busy, you probably wouldn't have the best time to day trade. So I think, in all honesty, swing trading gives you the best opportunities for everything, okay? Now, let's get into the trading aspect of things that's into the depth, right? Into the theory of trading, all right? The stock market behaves like an auction, okay? That's why it's called the auction theory. So it moves up, the price moves up until the last buyer buys and moves down until the last seller sells. Market order, right? That's one of the orders that you'll see when trading that'll come out, right? Market order. You're filling an order at a certain price that is at market price. When you go and you see like you're trying to buy some fish at some restaurant, if you went to these like nice restaurants, or you're trying to find or buy a fresh fish, something like that, do you always see like the market price? Like sometimes I go to like a restaurant, like my bro, my brother just went to a pretty nice restaurant, a seafood restaurant, got some oysters. We saw, it was market price. You don't really see the price because it's whatever market price is. Think of it the same thing with trading. Market price, right? It's whatever the price at the market is right now at the moment. That's market order, and you can get filled at that market price you want to. There's a market order button on everything you trade that if you want to get filled with the market price currently, market order, right? Now you also have a limit order. It's different because you're filled at a selected price level to your choosing. So let's go back to the food thing, right? Let's say you want to get buy some oysters at a level that is lower than the market price, right? If you understood, let's say if you're able to know what prices are like that in oysters, right? You want to buy these oysters, you want to order these oysters when prices at let's say market price is at 10, you want to buy it at 5, right? So once price goes down, market price of the oysters go down to 5, that's when they give it to you, okay? Do you understand what that means? So limit order is that filled at a selected price level to your choosing. Whatever price level you want to choose to get filled is a limit order. Simple. Stop order placed after getting into a position to minimize risk. So with a stop order, let's say you're in a trade and you're trying to target a certain level. Let's say you got in a trade at $5 and you're trying to target a $10, right? So $5 move to $10. That's your take profit. That's where you're getting money. Your stop order, let's say you don't want to be in this trade anymore if price goes below 3. So if price goes below 3, that's your stop order. Your stop order is at 3, right? So after price keeps dropping down into position, you want to minimize risk, so you're going to get out of the trade at 3. That's a stop order, right? It's the price that you're trying to get out at to minimize the risk. We go into a lot of things and a lot of concepts about trading, but the most important one is the smart money concepts, okay? So you're trying to, number one, you're trying to find price levels. Significant moves up or down in terms of these price levels, okay? So zones are where orders get filled, all right? And so when you're finding these price levels, you're looking for significant, strong moves up or down. And that zone, like I said, are where orders are getting filled by who? By the institutional traders. Because again, they make up 97.8% of market transactions, right? So when you're seeing charts moving on the screen, that's the institutional makers, all right, making the moves up or down or consolidating, right? And retail traders, 2.2% of market transactions, all right? We are nothing, okay? We're just following the wave. Like I said, that's why we're trying to find these important price levels, okay? Volume, no such thing as buy or sell volume. Volume is volume. Even if it keeps going up, that's volume. If it keeps going down, that's volume, okay? That's smart money concepts for you, all right? Volume is just volume. It's showing you the strength of the market at that certain candle, at that certain time, and you're trying to find price levels where there's significant volumes either up or down. These zones are where the institutional traders are getting their orders to get filled, all right? And we're trying to follow a direction up or down where we think price is going to go after. Now, there's a bid and an ask spread, okay? This can be seemed as pretty kind of complex for you guys, but it's actually very simple, all right? The spread is just the ask minus the bid. And what the bid is a price a buyer is willing to pay for the asset. You'll see a lot of bid and the ask on every kind of broker, every kind of trading platform you have. Bid is the price that the buyer is willing to pay for the asset, all right? The ask price is the price a seller is willing to accept for the asset. And the spread is the difference between those two, okay? Very simple to understand, because you're always in a liquid volatile market. The spread should be tight, right? And when you go to more scarce market, right? Let's say you're finding, the easiest thing is finding currencies that aren't that volatile or stocks that are pretty low. They're not well known. That's where you're finding wide spreads, and that's a bad thing. Bad thing. Big no-no. Fuck that. You will lose a lot of money trying to get wide trades into wide spreads, okay? Tighter the spread, the better. The tighter, the better, right? Understand that. Find the spread of each currency or each market, whatever you're trading, and if the spread is tight, good. If the spread is small, that's a good thing. Volatile and liquid market, you can get filled at a price that you so deem necessary, and you won't get filled at a pretty bad price if the spread was so wide, all right? That's why it's literally to help you, right? Don't trade things that have wide spreads. Next thing is simplicity. Simplicity is pretty key in my opinion, okay? Just because the more you make trading easier, the less worry you have, right? The less you have to be nervous about, all right? So that will help you become more profitable. I'm not joking you. Like, people think having something, making it overcomplicated will make you more money or make you better at trading or anything. That's not true. When it comes to trading especially, again, I'm talking from experience. it's very good to make it as simple as you can. All right. Nevertheless, it's still complex in some way, but it's as simple as you can make it. The more simple you can make it, the better. All right. Now, number one thing to make it simple, pick 5 or less tickers or symbols to trade. I have about 5 around that, all right? Just because you don't want to get lost in that mumbo jumbo, all that dangling shitty stocks, all the other tickers, trying to find 10 different tickers or symbols to trade, having to go from one to the other. You don't need that. You can become profitable with 5. You can become profitable with 3. You can become profitable with fucking 1, all right? 2. Like, it doesn't matter. Just try to pick 5 or less, okay? I'll show you the ones I pick and I trade, and then you can go into that with how you deem it necessary, right? But I'll go off forex because I trade gold with forex. I do gold, XAU USD, silver XIG USD. I do Nasdaq, right? Nas 100. I do S&P 500, US 100, US 30. You know, sometimes stuff like that. But like I usually just stick to 5, right? When I first started out, I stuck to 3. I only did, I would say, I think it was, I know the 2. I know I only did gold and Nas, but then I entered also S&P and what was the other one? Silver. So yeah, so just pick 5 or less tickers or symbols to trade. I would probably go to 3 to 5, just depending on how comfortable you are with having more or not, right? But next thing is analyzing more will just cause you to go crazy. So like I said, trying to analyze 10 or more different symbols or tickers will make you insane and will just piss you off to the point where you're just not that motivated to, you know, trade at that point, right? So that's why, because understand, like I said at the beginning, I said that each ticker has its own personality. Each market has its own personality. Each symbol, each company will have its own personality. Learn how they move. Try learning how 10 fucking companies or currencies move. That is just too much for your brain, no matter who you are. Just use 5 or less, 3, all right? However much your brain can take. Learn their personalities because they're all different, okay? So yeah, simplicity is pretty much key. That's one of the biggest things I can give you, so you can take throughout this entire 3 hours so video is that, okay? Now, you'll have swing trading opportunities. Get back there. And these are the opportunities that you're kind of gonna want to see, all right? And I'm gonna give you a little assignment at the end, but first look at this, all right? You want to identify major support or resistance zones, all right? Major support or major supply or demand zones. You can name it both things you want to. It doesn't really matter. They're the same to me in my ways, all right? They are kind of like battlefields between the buyers and the sellers, okay? Because you're using kind of in between that as your opportunity to make money, right? In between the buyers and the sellers, right? You have the support, you have the resistance, you have the supply, you have the demand, and the battlefield between that, between buyers and sellers, is what you're using to try to make money, right? Because if you're with the buyers, you're trying to get the buyers to defeat the sellers, but if you're trying to make the price go down, you're with the sellers trying to defeat the buyers. So it all adds into identifying these key zones, and we'll go into that obviously. But first thing you want to do is you're going to want to use multi-frame analysis, okay? The higher the time frame, the better you are to define your bias, all right? That is only because you are trying to use a multi-time frame analysis, but when you're trying to find these big zones, these important key level zones, you're trying to find it because you're swing trading off a broader market. Even if you are day trading too, you're trying to find it off a broader market. So that's why the higher time frames are better, like the 4 hour, the daily, the hour. They're good, right? And where you get the lower time frames, that's where you're going to fine tune your entries. If you're swing trading, 15 minutes, 30 minute is a pretty good ideal fine-tune entry time frame, okay? But higher time frames, like let's go to 4 hour, the 1 hour, the daily, maybe even the weekly if you're investing and that sort of thing, which you don't really need to, but it's a good way to look at the overall broad market of whatever you're trading or investing in. Perfect, all right? So that's all you need to understand is the higher time frames help you define the bias, and you know, if it's an uptrend, if it's in a downtrend, if it's consolidating, you know, where the key important zones are. And the lower ones are where you're going to get your entry to find the perfect sniper entry, all right? Now you're also going to want to combine the volume spikes and the structure shifts to validate momentum, right? So let's see if there's big volume on the buyers, right? And you're trying to go long. Big volume on the sellers, you're trying to go short, you're trying to take price down, right? Let's say you're in a support, resistance and a supply and demand level, right? And this is where the sellers are strong, and this is where the buyers are strong, right? Good. Try to see if you're trying to go, and break the supply where the sellers are strong right here, right? That's momentum. You're trying to validate momentum with a structure shift. It breaks that high and it keeps going. Buyers are good, right? And I will show you again what I mean by that and more complex, because that's just an example. You don't need to know what I mean in this part, right? There's still way more to come, right? I'll show you exactly what I mean by volume spikes, structure shifts, bounces, rejects, all that kind of stuff upcoming in the more strategy part of this video, this course, okay? Wait for confirmation, right? Patience filters the noise. A lot of you guys are patient, and I know a lot of you guys are, a lot of my viewers are young people, millennials. You not as patient, all right? I'm not gonna lie to you. Not as patient as you can be. It took me a while to gain that kind of patience too. Wait for confirmation, okay? Because you're gonna regret it if you don't, and if you try to get in too early, okay? Mini assignment for you guys, all right? Little mini assignment. You can pause it, or you can just let the video go through too, whatever you want to do. It's a pretty long video. If you're trying to take breaks, which I would recommend you do, go ahead as well. But mini assignment, analyze your favorite instrument in 3 time frames, right? If you don't have a favorite instrument, just pick one of these 3. Pick gold, pick S&P 500, and pick NASDAQ, all right? If you don't have any of them. But if you do, analyze your favorite, or one of the ones you chose, instrument or ticker or company in these 3 time frames, all right? 3 time frames, all right? And I want you to look at the daily, 4-hour, and 1 hour, all right? That's the higher time frames. I want you to look at those, okay? Write down the market bias for each of them, all right? Market bias for each time frame, okay? Obviously, the higher time frame will mark the higher trend of the overall trend of longer time than the other ones. But I want you to write the market bias for each time frame, right? Each 3 time frame, right? Pick one instrument, right? Don't get it confused. One instrument, just one ticker, like gold, and 3 time frames, and write down the market bias for each 3. Okay, pause it or move on with it and try to do it later. Whatever you want to do, just try to do this and see how you do. Okay, because I would do it now. Just because you don't know anything about it, we're gonna go into that thing, like how to actually look at the market bias for each later. But now that you're just kind of familiar with it, try to see if you do good, right? It's kind of just a boost in terms of confidence if you do get it right or not. And if you don't, that now you'll know that's something that you got to like learn and actually look out for. So yeah, mark out the market bias for each 3 of those time frames in your favorite ticker, and then you'll see how you do later. Okay. All right, into the second part of the course. This is the in-depth part of the course. It's going to be probably the most extensive one you can have. The first part was just going over most of the basics. The last part is going to go more over the psychological or mindset, shift that you should have as a trader, and go around that kind of stuff. With this part, the most extensive part, we're going over the grits and basically just the inside into the pit of trading. All right, you're going to find out your key levels. You're going to find out what strategies, or what strategy I have, what setups I have, all of these things. And we're going to learn a lot more about the market overall instead of just the basics and the psychological part, which still are very important. I think the most important part of trading is the psychological part, but this is probably the grit. This is something you need to know and you can learn pretty fast. First thing is, you're going to learn what your key levels are, right? You have key levels in trading, and you have to find out where they are so you can find them and know how to trade or where to trade. Now, you have one called supply, and you have another called demand. When it comes to trading, I'm not going to trade outside these zones. Now, you can call whatever you want. I like calling it supply and demand. Some people like calling it support and resistance. Some people have a problem when it comes to that. They're saying like, oh man, support and resistance isn't a fucking thing. It's a thing. You can make it. It's whatever you call it. It doesn't fucking matter. But supply and demand is what I like to call it. Now, I will not trade outside these zones, okay, unless it's on a squeeze, and I will tell you exactly what that is when I show you what the fuck a squeeze is, all right? You don't know what a squeeze is right now, and nor should you, okay? So supply and demand is the only thing I'll trade unless it's a squeeze. We'll get on that later. liquidity. Okay, this can be used as an entry if it's in supply or demand. Okay, and it can be used as a TP, but just know that liquidity acts as a magnet. All right, it's basically a magnet showing you where price is most likely to go. But it's really good to be used as TP, and it can be used as an entry if it's in supply or demand zone. Let's get on to supply and demand. Now that's zones where the smart money has shown interest in. All right, prices, smart money, investors, hedge funds, they look at the market. They look at the price of the market. They look overall where the price is at. They show interest in certain prices more than others. Okay, that's where zones are created because there's high liquidity or there's high interest in those zones or in those areas of prices. Now I'm going to show you how to draw them. I'm going to show you how to use them to actually trade and make money. Pretty simple. You'll find them pretty easily. It might, honestly, for my students, sometimes it might even take a month, but I've never seen it go further than that on how to learn how to find and use supply and demand zones, okay? Now, understand that you have time frames when it comes to trading. These time frames are for finding the levels, all right? Not for trading, but finding the levels. Daily time frame, the 4-hour time frame, and the 1-hour time frame. Now, the most popular one is probably going to be the 4-hour time frame. If you're day trading, you're going to use the 4-hour time frame a lot. If you're swing trading, you're going to use the 4-hour time frame a lot. Daily is also good for swing trading or investing in general because you're looking at the overall market per day, per daily session. That's not a bad thing to look at as well. But just understand that you're going to find yourself looking at all of these levels for finding the levels. All of these time frames for finding the levels. And that's the daily, that's 4 hours, that's hour. If you want to even go further than that, you want to use the weekly, monthly, whatever, go ahead. That's not a problem. I'm just telling you which ones I use and which ones give me the most benefit. And these are these three. All right. Now, for me to trade, when I'm actually swing trading, I might use the 1 hour, and I might use I most likely am going to use a 30-minute to 15-minute time frame to actually get my entries when I'm swing trading. But I'm using the 4-hour and 1 hour and daily time frame to find these levels. Okay. Now, going into what we're going to classify as the big move. Okay, the bigger the move, the more volume it is, or the more volume there is in that move, the stronger the move is. Okay, so what to look for? You're looking for one massive big body small wick candle. All right, wicks, and I'll show you exactly what wicks are when I see a picture of the charts. But you want to look for one massive big body and a small wick candle. Okay. And also another big move is 2 to 3 big to medium sized candles with big bodies and small wicks. Now, looking at supply, okay, and you can see by these wicks, these are wicks, right? It's where price has not fully closed during this session. Each time frame is a time, right? There's a time for each time frame. Let's say this is a 1 hour candle, all right? This is a 1 hour candle. That means price, where you see this body, this is what I mean by the body, price moved around all of this, yes, but it didn't close in between, all right? It opened here and it closed here. These are wicks. You want to find small wicks, okay? So for supply, bear in mind, listen very closely so you understand the difference between supply and demand. Supply, it starts on the 4 hour, okay? We're looking at the 4 hour here. We identify a big move down. So identify a big move down. Identify consolidation or equal highs or neutral candles before the move. You see consolidations here, you see small candles, neutral candles. That's what it means. That's consolidation, all right? And then you want to see the top of the zone is high of candle or the consolidation range, okay? So you can do the high of the consolidation range, or the top of zone is the high of the candle, all right? Whatever you want to do is completely up to you. Then you want to look at the bottom of zone. That's going to be basically the neutral candle or consolidation, all right? So the bottom of zone is bottom body of the neutral candle or consolidation, as you can see here, all right? This is supply. This is more used for selling. As you can clearly see, this is the top of the supply zone. This is the supply zone. This is used when, most more likely, candles are selling, right? But it can also be used for when you're trying to buy too. We'll get into that. I'm not trying to make it too difficult for you right now in this video, in the beginning, but it's going to get more extensive and more complex. But right now, just understand where supply zones are, right? You start on the 4 hour, you can start on the daily, And okay, you can even go to the 1 hour to fix up your zones, but we're starting on the 4 hour. Okay, identify the big move down like these. All right, big move downs. One like we said in here. What's a big move? One massive big body small candle wick. Da da da. 2 to 3 big medium sized candles with big bodies and small wicks. Da 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 da. You know what I mean? It's pretty simple. Then you want to identify big move down. Then you want to see the consolidation before it. All right, equal highs. Like this, okay, or neutral candles. See consolidation, neutral candles. Top of zone is a hive candle, all right, or consolidation range. That's where you're putting the top of the zone for, all right. And usually I like to start at the top first and then move down my zones. However you like to do it, it's completely fine. But I like to start at the top and then move it down. Bottom of zone, all right, is the bottom body of the neutral candle or consolidation range, all right. Now, it really just depends on where you want to put the bottom of your zones. It doesn't have to be perfect. Understand, especially if you're new to trading, you might get so caught up in this like I did at the beginning. Your candles don't need to be perfect, okay? They don't need to be right on the bat, because guess what? We all draw our zones so differently from one another, but somehow we still make it work. My brother, I have friends, we draw candles so differently, we draw zones so differently, and our strategies doesn't even lie the same. That's what doesn't make sense, right? It doesn't make any sense to you, but it should, right? We don't have the same strategy. We draw our zones in different places, and even if we do have the same strategy, even if we do draw our zones in the same places, it's not going to be perfect. That's okay. It's not the end of the world. You're still going to be able to become profitable doing that, all right? I'm just showing you exactly how I draw my zones, so if you want to draw it like this, you can. That's supply for you guys. Demand, pretty much just the reverse. Simple, but the reverse, all right? Start on the 4 hour. Identify a big move up like this, all right? Like we said behind. One massive big body, small wick candle. This is what you get, all right, man? Start right here, all right? Identify a big move up like you did. Then you want to identify consolidation or equal lows, all right, or neutral candle before the move. These are neutral candles. These are consolidation, equal lows before the move. Top of zone, right, is top of body of neutral candle or consolidation, like you see here, right? Again, it's not perfect. It doesn't have to be, all right? Top of zone, all right, and the bottom of zone is the low of candle or the consolidation range. As you can see here, this little neutral-ish candle, kind of a doji candle, not too much. It's more bearing on the selling side, bearish side. That's okay. It's still going to be perfect for us, all right, because of this big body candle right after. Put it below, all right? Below, top of zone is going to be the top of the body of neutral candle or consolidation like it is now. And then the bottom of zone is going to be the low candle or the consolidation range, all right, like it is here. Then you're just going to repeat all the way down 30 minutes and keep doing it. Or I would say repeat all the way down to 30 minutes. I wouldn't do 30 minutes. I would just go from daily to 4 hour. And if you just want to use the 4 hour, go ahead. But what I would do is I would go from daily, put my zones there, 4 hour. That's the most important time frame, the 4 hour. Look at my zones there, and then go to the 1 hour. Find any 1 hour zones. Try to fix up your 4 hour zones too to align better with the candles if you must. And then go to the 30-minute candle and see where you got. All right, see where all your zones are in the 30-minute candle, because most likely that's where you're going to make up your entries, 30 to 15 minutes. Or however kind of swing trader you are, 30 to 15 minutes. All right. That's a demand. All right, so you understood now. Supply is just you're looking finding big move downs. All right, big move down. Demand, looking to find big move up. All right, that's it. That's literally it. Now there's multiple market structures. Well, three market structures that kind of identify the overall market. You have balanced, which, like I said beforehand, like consolidation. That's what balanced is. Buyers and sellers are agreeing on price. That's consolidating. Price is consolidating. It's not breaking any range. Bears, and I don't know how you could kind of assess in making like a sort of way you can understand it, but just in my ways, you just got to learn it. It's pretty easy. Bears, sellers, all right? Bears, sellers are in control. Sellers are controlling the market. Market's going down like you see here, all right? This is a bear market. Bull, buyers are in control, all right? Like you see here, bull market, all right? Buyers are in control. Doesn't really get any more simpler than that. Balanced, consolidating market. Bear, it's a bear market. Sellers are in control. Market's going down, basically. Bull market, buyers are in control. Market's going up, basically. The bull market, all right, how you identify a bull market, you go on the 4-hour time frame. Is it an uptrend? All right, you want to find uptrends. You want to find 3 higher highs and 2 higher lows, okay? And you want to know that because bull markets is where you're losing demand levels or supply levels to take the market up, right? So you either want to go long off demand or a break and retest of supply. And again, you don't have to know what this means, all right? You don't have to know what this means. I will show you what it means. This is just so you understand what bull markets are. I will show you what all this means pretty soon. A bear market, you're on the 4-hour, you're looking for a downtrend. That means 3 lower lows and 2 lower highs, okay? And you're looking at a bear market because you want to go short on the market. You want to sell the market because the market is selling itself. So you want to go short off supply or a break and retest of demand, all kinds of things that's going to help you sell the market. Balanced market, it's just consolidating. It's neutral. You look in the 4-hour consolidations. There's no breaking of range, right? There's no breaking of range. You have ups and downs, up and down, but it's just staying in this range. 3 equal highs, 3 equal lows, staying in the range. That's a balanced market. Now a fade, think about it. Don't even think about it when it comes to like hair at all. All right, a fade is the best chance at winning. We want to fade the 30-minute structure into the 4-hour. All right, so identify the 4-hour structure, identify the 30-minute structure. Bear fade. All right, this is when we're actually looking to sell the market. This is a bear fade. We want to look at the 4-hour bear market. All right, we want a bear market in the 4-hour time frame, and we're looking for an uptrend on the 30-minute chart into supply for shorts. All right, into supply for shorts. Now, if I go back here, you can see what supply is. Like I told you, this is supply. A bear market is a bear fade, is showing that the market's going up to supply, so we can look for shorts back into supply. That's a bear fade. Like I said, because bear is sellers in control. All right. Then we look at the bull fade. It's just opposite of bear fade. Look at the 4-hour bull market, and you look into the 30-minute downtrend into demand for longs. 30-minute downtrend into demand for longs. That's what's fading, because you're not looking for a bull. You're not looking for uptrends in a bull market because it's just going up and it's going up. Well, you can, but a bull fade is a different aspect of it. It's a different name. Bull fade is just how we see here on the long market for demand, right? We look at the market. Let's say the market was going down into demand, and then we push back up. It did have a nicer picture on the bull fade. Let's say, market's going down into demand and push back up, right? Down into demand and push back up. Down into demand and push back up. Stuff like that. Down into demand, push back up. That's a bull fade, right? Because we will look at an uptrend in the 4-hour bull market, and then we look in the 30-minute time frame, and then we look at for a downtrend into the 30-minute time frame into demand for longs to take the market up. That's what fading means. When you hear fading, that's exactly what it means. You're just trying to fade a certain time frame into another time frame. So you're trying to look at the higher time frame, whatever high time frame you use, and you want to see, is it going in uptrend or is it downtrend? And then you want to see, let's say it's going in downtrend. You do a bear fade. All right, that's what a bear fade means. If someone's saying, "Oh, I'm gonna fade the 30-minute onto the 4-hour," you're looking for a bear fade. You're looking for a downtrend on the 4-hour bear market. So it's a sellish market, and then we're looking for an uptrend on the 30-minute time frame, 30-minute chart into supply for short, because it's a bear fade. We're trying to reject supply so we can keep selling. Bull fade, just the opposite. 4-hour bull market, 4-hour uptrend like it is right now. And then we go to 30-minute, look for a downtrend into demand for longs, take the market up. Very simple. This is called going against structure, all right? If you ever think of a time where I don't know if you're new to trading at all, or if you've been trading. If you ever think of a time where you have gone against the overall structure of the market, it's risky, right? You know it's riskier. You're not going to win as many trades as you would if you were just going with the trend, going with the structure. That's why you always have to wait for the 30-minute structure shift first. Wait for structure to shift on the lower time frames to get a better indication that you can go against the trend. You can go against the structure, all right? My idea or my opinion, if you're starting the trading, if you're new to trading, if you're not profitable yet even, I wouldn't go against the structure most of the time. All right, I do sometimes. It's not the best case scenario for me, but you know, at the end of the day, I keep my wrist tight when I do that. That's all you can do because you're going against the market. You're going against investors and hedge funds. You're going against the big players. When you go against the big players, you better have the balls to know that you might lose. All right, you gotta have the balls, and you gotta know that you're gonna lose. You might lose. Chances are you probably are gonna lose. Keep the wrist tight and make sure that you're waiting for the 30-minute structure shift first, of course, if you're swing trading, to go against the trend, go against structure, okay? But I'm telling you, this is a warning from everything that I can give you in this video. This is the biggest warning. If you're starting out, if you're not profitable yet, be wary of going against structure. I would recommend you not even to do that, okay? Go with the trend. You'll be much better off. Your win rate will be way higher. You might not get into as many trades if you were going against the structure, were going against the trend, but at the end of the day, you know, you're taking one off and you're trying to weigh the benefits and the risks. I don't think you going against the structure is going to win in terms of benefits and risks, okay? That's just my opinion. If you want to do it, go all out, sure, go ahead, but beware, all right? And it's on your own. I'm not going to, don't come back to me or any of your mentors or whatever saying, man, I went against the trend. You said I could. No, I didn't. I said you can if you want to. I'm not going to tell you do it. You know, go against the trend right now. Do it every single trade. If you see a good trade that's going against structure, go ahead and trade it. I'm not saying that. I'm saying be wary of it. And if you are, this is what you should do first. Okay, wait for a 30-minute structure shift if you're swing trading first, going against trend. That's it. Now, liquidity is pretty easy to understand. It's places that attract a lot of buyers and sellers, okay? Prices, interesting price range, or interesting price highs and lows, basically. And as you can see here, it's pretty simple. Session lows and highs. You have London session, Asian session, New York open, the New York close. All of these are liquidity levels you can place down knowing that price is attracted to these levels, okay? Or the market is attracted to these price levels. Equal highs and lows, at least 2 or more. Those are liquidity levels too. Those highs and those lows are liquidity levels because price is attracted to that. It doesn't go above it or it doesn't go below it as much, okay? So let's say if price goes up, you know, up, and then it comes down and it hits the same low that it went up at, and it doesn't go below that, again, that's a liquidity level because price is attracted to that level and it's holding that level pretty steady. Let's say it goes back up at that level and it gets to that high that it just created and it stops at that level and it goes back down. Liquidity level, all right? Because price attracted to that level, it goes up but doesn't go above that, all right? It wouldn't be a liquidity level. It wouldn't be attractive if price just broke above that, okay? And like I said here, Asian high, Asian low, London session, high, low, New York session, high, low, Asian session, like all of this is liquidity levels, okay? Session liquidity. Like I explained, market seeks liquidity. It acts as a magnet for the market. Price is most likely going to go into there. That can be used as an entry trigger, all right? Entry trigger. Don't let it be used as a zone. It can be used as an entry trigger if it's used in combination with supply and demand. All right, liquidity is really good, but don't let it just be any entry trigger if it's not in supply and demand. You want to make sure that you're trading in a zone, guys, not just overall in the market. So you're like, oh, this is liquidity. This looks like liquidity. It's not in a zone. Don't touch it, okay? VWAP. Pretty simple on what VWAP is. This is the only indicator I use, and I don't even use it all the time, but this is the only fucking indicator I use. Excuse my language, but people use so many stupid ones nowadays. It doesn't even make any sense. I don't get it. You're not looking to win the market by looking at these algos or these tools that they have for you. Like that doesn't make any sense, okay? Just take it. This is probably the most important and only indicator you can use, except for volume maybe too, okay? But that volume, I guess, is an indicator, but at the end of the day, you're not really looking at volume as much. So just VWAP is the only indicator I use, and again, go at your own risk if you want to use any more like RSI, MACD, or whatever those are. You should already know, or if you're new to beginning, now you should know that those are all a bunch of crap. VWAP, volume weighted average price, the only indicator I use. It's used to see the daily range between buyers and sellers, and what's the fair price of buyers and sellers. What price do buyers agree on that day mostly, all right? The average price of that. It's used by institutions. Like I said, what price is are buyers and sellers agreeing that's the fair average price for the day? That's VWAP, all right? It's very respected, and it's a good take profit level and even a stop loss level. Don't use it as an entry level, all right? Don't use it as supply and demand. You're going to fuck yourself over a lot. You might get lucky once or twice, but you keep on doing it, you're going to get screwed over, bent over, and VWAP's going to get you, all right? Don't do it. Just use it as a good confluence. Use it as a take profit level if you must. If you don't see any other levels in sight, use it as a stop loss level if you must. If you don't see any other strong levels in sight, but you should because you're only trading on supply and demand levels. Or are you? I know, but that's just my piece. I would only use it as confluences or nice entry triggers to, sorry, not nice entry triggers, nice triggers to take profit and to put your stop loss on. Now, why VWAP is important, is important. I already spoke of it, but here's more of an example. You can think of it in this scenario, right? If a few people buy one cookie each for $2, but someone buys 100 cookies for $3, okay, then $3 matters more because it was a much bigger buy. More people bought the cookie for $3, even though $2 was cheaper. That's what VWAP does, okay? It shows the true average price during the day, or however long you want to look at it, based on how much was traded. Big investors, hedge funds, these billionaires, right? These companies buy and sell millions of dollars worth of stocks, and they use VWAP to see if they're getting a good deal. If the price is better than the VWAP, they did well. So what that means is, you look here, right? You see the VWAP. You see above the VWAP and you see below the VWAP. How you can think of it is looking at, like, think of, if you ever want to understand who's in control right now during the day, right? You can look at uptrends, you can look at trends, whatever you want, but you can also look at VWAP. Who's in control? VWAP is the average respected price, right, from buyers and sellers. So you would then deem if it went above VWAP, buyers would be in control because it's above the respected price or the fair price of the day, the true price of the day. And if it's below VWAP, you deem that sellers are in control. That's basically it. That's basically what this is showing you and this is showing you, all right? See if they're getting a good deal. If VWAP was below, this is a true price of the day. So imagine if they got a good deal, they would get a good deal below it. Buyers would get a good deal below VWAP, right? Because if they got a good price and it goes up, they got a good deal. That's kind of what it means. Well, it's basically what it means. Let's see if it's above VWAP, right? Seller, let's see if you're trying to short the market. Did you get a good deal above VWAP? Yes, you did. It's a lot more in depth into that. There's a lot more things that go around this, especially if you're investing like in companies. You have to look at the financials, all that kind of stuff. But VWAP helps a lot in seeing, am I really getting a good deal? And if it's above VWAP and you're trying to sell the market, you're in a better position. And if it's below VWAP and you're trying to buy the market, you're in a better position. It's kind of all that it means. It's more of a, an analytical thing to look at. It's not really necessary. You can't just say, oh, it's below VWAP, so I'm just going to buy and get a good deal. No, because it could do this. You see what it's doing? Like, it's not a holy grail, but it's a good way to look at it. It's a good analytical tool to look at it. That's why I only use VWAP and I don't use any other indicator, because at the end of the day, none of the other ones do anything for you, okay? People use MACD, RSI to actually get in the trades. That's the stupidest thing I've ever heard. If you use VWAP for that, it's just as stupid as RSI and MACD. You would classify it in the same position. So don't use VWAP to get into trades, all right? Just use it as a tool, an analytical tool to see your swing trades and see exactly what's going on with the market. Just like you're looking at the trends of the market when you go in the higher time frames. You're looking at what's going on at the market. Now, this is the recap that we've got right now, all right, from the first video that we made. You learned the basics. All right, and then you learn the technical analysis. You learn supply and demand. You learn these zones. You learn where to find these zones, okay? You learn the basics and you learn the technical analysis. Now, guess what we're going on? The fucking strategy. This is the holy grail. This is exactly what you guys need to know and put your time in. This is the grit, right? This is the trenches. You're in the trenches right now and you got to learn this before you can move on. Don't get me wrong. This is the easiest part. Why is it easy? Because it's simple. It's like math. What's 1 + 1? 2. What's 2 + 2? 4. I could even go up. I know math, bro. I could go all the way. All right. It's easy. What's hard is the last video, the last part, the psychological part. But to get to that, you got to get to this first. Because if you fuck up on this, you're going to definitely fuck up on the psychological part. So make sure you're actually getting everything you need to know in this video when it comes to the strategy part. This is one of the most important parts, okay? So strategy. Now you have all the tools necessary. You've had the basics. You've been taught the basics and you've been taught the technical analysis. You've learned supply and demand. You've learned uptrends. You've learned all of that, okay? You learned everything. You learned bull market, bear market, all of that. Now look at the strategy. I will be divulging my own strategy that has made me millions in the market, okay? And it's been tweaked every now and then for years to become this amazing, profitable strategy and setup that has a significant win rate, and it's been capped at that win rate because I'm still trying to even better my strategy, but at the end of the day, it's been over a year now, and this is the best it can get. I have an over 80% win rate, okay, in all my setups when it comes to swing trading, and that's because I've been tweaking it for years to get to the best point I can be where I can teach you this strategy. There's going to be multiple setups. All right, you're going to have setups for longs, that's buying the market, setups for shorts, selling the market, and you're going to look at balances, what rejects are, what breaks are, what breaks and retests are, what liquidity sweeps are, what squeezes are. Like I told you, squeezes. That's the only thing that you're overlooking some zones, and you're more looking at liquidity, okay? Or the trend, so to say. Now, longs. Longs, we go off to buy the market. How you can look at buying the market is you can look at, for setups, you can look at demand bounces, you can look at breakout supply, you can look at break and retest of supply, you can even look at liquidity sweep at demand or squeezes, which we'll get into that. I don't put it on there because at the end of the day, I don't think you should really get into it unless you're actually more advanced when it comes to trading. But I'm still going to add it on there so you see. Demand bounce is you're in a demand zone, you're with the 4-hour trend, the volume dies off as price approaches, and there's less interest as we make those lower prices, okay? And I'll show you exactly what all that means. The candle closure, you're above the zone with a close above the previous lower high created on the 15 to 30 minute time frame, okay? And your stop below the demand zone. This is literally what it means. You got a demand zone, you see a pullback with volume dying into this demand zone, and you see candle closure. It does wick the demand zone, but you see candle closure above the demand zone, and that is your entry to go in for long at the candle closure above the demand zone. After this level, it does go up here, it does go back down, but at the end of the day, where's your stop? Below this zone. So you can see people are going to tell me, but you can go here, right? Or you can go here. So where do you go? Because if you go here, aren't you going to lose money? No, because your stop is at a significant area to the point that if it does go below it, you are understanding that you're going to lose the money and it's not really going to go back up anymore. It could wick your stop. It's just life. It's the market, whatever. But the probability is that it's not. Okay, most of the time it's not. More than 80% of the time, it's not. So look for like I said here, in a demand zone, check. Is it with the 4-hour trend? Check. Is volume dying off as price approaches zone? Less interest as we make lower prices, meaning less selling interest as we make lower prices? Yes. Okay. Candle closure above zone with a close above previous lower high created on the 15-minute, 30-minute time frame? Yes. Okay. Yes. You see what I mean? You see what I mean here? Stop below the demand zone. Even if you get into here, okay, even if you get into here, it doesn't matter because the stop is going to go here. So even if you get into this trade here, right, and you see price going back down, can you see that the fact that it didn't go back down all the way to below the zone? So you're still in the play, right? Unlike you, I would keep my trade. But if you're a scared little, excuse my language, but scared little bitch, you're going to get out here and not understanding that you shouldn't get out earlier, okay? Don't get out earlier. Keep your stop and your take profit right where it is. You can trim along the way when you're taking profit, sure. Make sure you're taking all of it off at a certain take profit level. And when your trade isn't going your way, keep your stop. don't move it down, thinking the trade is still going to go up your way. Keep your stop, because if it does break the zone, chances are it's going to keep going down. Okay, and you're trying to take the market up. That's not a good sign. But at the end of the day, it's pretty simple. All right, demand bounce. You're in a demand zone. Price is dying off, so enters the demand zone, and then you're going to look for a entrance into the demand zone. It doesn't matter if it's a wick or not. All right, it can be a body, it can be a wick, whatever. Look for it to go in, and then look for a candle closure above the zone. Pretty simple. You want to maybe even ally it with a candle closure above the previous lower high created on the 15 to 30 minute time frame. Okay, and then once it goes back up and closes above the zone, you get into your trade, and you take a long to a certain take profit level. It can be at this high right here, at this high. It doesn't really matter where you're taking profit level, as long as it's a valid level, basically. Maybe even VWAP too, you know. It's liquidity sweep at demand. So liquidity sweep is a little bit more in depth, but it deals a lot with high volume and high interest on certain price levels. Okay, and it's very, very accurate. Demand bounce gives me an 81% win rate. Liquidity sweep gives me an 83% win rate. It doesn't seem like much, but 2% is a lot when it comes to trading, okay? You'd be told that by a lot of traders. 2%, if you're actually doing it right, if you're actually backtesting right, if you're actually trading right to see your win rate, it changes a lot. It does a lot. You're in a demand zone, okay? Same thing as the demand bounce. 1 second here, guys. You're in a demand zone, all right? You're with the 4-hour trend. The volume is dying off as price approaches the zone. Means less interest as we make lower prices. Okay, same thing as the bounce. You're in a demand zone, 4-hour trend, volume dying off as price approaches. Then the difference between this is the price sweeps liquidity below closing. All right, without closing on the 15 to 30 minute time frame. What that means is price is sweeping liquidity, previous liquidity, below, but it's not closing below that liquidity. If that closed below the liquidity, that would signify that trade is still probably going to go below and down, right? It's not really going to get reversed back up. It might, but chances are it's not. So when price sweeps liquidity below without closing on the 15 to 30 minute time frame, you want to let it reverse back up, and you want a candle closure above the zone on the 15 to 30 minute time frame, and you want your stop below the lowest point of liquidity. This is what that means, okay? This is actually a trade I took as well. So look at the liquidity sweep. You see the liquidity sweep, okay? Liquidity sweep. These are liquidity sweeps. This is where you buy it at that zone up, right? So how you can more so look at it is it's just easy liquidity sweeps coming from a interesting level, or a level that's a level that's kind of acts as a magnet, right? There's high interest of buyers and sellers at that level. Once it sweeps that liquidity and it closes back up the zone, you take it for longs, all right? It's very simple. This is a liquidity sweep. It gives you a high probability chance of winning the trade, higher than even a demand bounce, but it's just simple, all right? It's kind of like when price is going back down, you want to see, is there a liquidity level at the demand zone, right? You can even have a demand zone looking for a demand bounce, or a liquidity sweep, right? If there's a liquidity level at the demand zone. So it's very simple. You know, you're basically just looking like you look at the demand bounce, right? You're looking, is it going down? Is volume dying off on both of them? In a demand zone with the 4-hour trend, so the trend is an uptrend. Is volume dying off as price approaches a zone, right? That means it's less interest for sellers as we make the lower prices. We keep going lower. But we want to make sure that it's still going down, but it's losing its strength. Sellers are losing its strength as it's going down, okay? Then we want to look, is price going below that zone? It's breaking that zone here, because you would have a zone right here, okay? It's breaking that zone, and then it's reaching towards the liquidity of that zone. Once it reaches towards that liquidity, and I use my liquidity levels as a line, right? A price line, horizontal line, rather than just a zone like this, okay? Why I do that is because there's demand zones with liquidity and there's demand zones without liquidity levels, okay? And I use that to look at these horizontal lines to look at the exact point of liquidity, the lowest point of liquidity when I'm trying to go long, right, from demand. Selling and shorts, very different with supply, okay? But this is demand, this is what we're talking about right now. I look for liquidity to go down. I look for the lowest point of the liquidity level so I know when it's sweeping liquidity. So once it does sweep liquidity, right, price sweeps liquidity below without closing below on the 15 to 30 minute time frame. That's very important because I'm making my entries on the 15 to 30 minute time frame. Once I see that, once I see price sweep liquidity and then close above it, I look at the next candle. Next candle is right here. Once it swept this liquidity and went out the zone and then closed it above, I'm looking at the next zone for entry. And then I'm putting my stop where? Below lowest point of liquidity. Where it swept liquidity, I don't want it to go back. Okay, this is the new liquidity it just created because it swept this liquidity. I don't want it to go back and hit it below. That's why, but and a lot of people do this very wrong, is they put it exactly at liquidity or a little bit above it when they're going long off liquidity sweep. Price could go back and hit that. I've been stopped out. I've seen traders been stopped out of hundreds of thousands of dollars because they messed up their stop and put it just a little tick or basically right at the liquidity level. So many people will tell you, even hedge funds, even Wall Street brokers will tell you, they'll tell you, we're hunting for your stop loss. And at the end of the day, you want to make your stop loss the best possible place you can put it, all right? Below liquidity. Stop below lowest point of liquidity, not at lowest point of liquidity. Put your stop below the lowest point of liquidity, below this level, not right at it, below it, a little bit below it, just so you can make sure that if you do get stopped out of that trade, it's a valid stop. Because if you put it right at liquidity, it's not a valid stop because that might tick you. It might tick you out, wick you out, and then go right back and do its thing. So just know that even though liquidity sweeps are a higher win rate than most things, it can still wick you out a lot if you don't do it right. You have to do it exactly right, all right? And that's why when you do your stops below the zones for demand bounces or whatever, you're doing it below the zone, not on the zone, because price could still go back to the zone like it did here. Even if you were going to trade here, which I wouldn't, but even if you're going to trade right here and take your trade here and you put your stop below the zone, on the zone, you could still get stopped out. That's where you get stopped out if you put your stop below the level where it entered the zone, basically, right? Below this level. No, you want to put it below the zone, all right? Below the zone. Unless you're dealing with liquidities. Unless you're dealing with liquidity sweeps, that's when you put it below the liquidity level, okay? Very simple, pretty straightforward. That's a liquidity sweep when you're looking for longs. Break and retest of supply, another long trade, but this time you're using supply. This is where it gets a little bit weirder for you because you're usually like you said with we were talking about bull fades just now. You're looking for a downtrend into demand to go long. This isn't a fade. Now you're looking to go up for longs. Basically, you're looking to break supply to go longs. Okay. Pretty simple way to look at it is it in a supply zone? Are you reaching a supply zone? Yes. All right. Is it the 4-hour trend? With the 4-hour trend, again, you're looking at it with the 4-hour trend. You're looking for longs when the market's on an uptrend, a bull market. Yes. Volume increases as price approaches and breaks the zone. You're more interest as we make higher prices. This is a little bit different from the liquidity sweeps and demand bounces because sellers are in control until we hit the demand level. But we're going long off supply, so we still want buyers to be in control as we break supply. So it's just a little bit different. Understand when you're looking at into demand levels to go long, you're looking for volume to die down as we approach the demand level because sellers are still in control. But if price dies down as sellers are still in control, that means that buyers are stepping up to get back into control. But with the breakout of supply, buyers are already in control. We want them to be in control. Frankly, we want them to be in more control. So that's why we want to see volume increase as price approaches and breaks the supply zone. It's more interest on the buyers as we make higher prices. And then, look at this. Is price retesting the zone? It enters the zone, right? It breaks that zone, breaks the supply zone, but then it retests back down. It pulls back down with the volume dying off. Because once it's just like the liquidity sweep and the demand bounce, right? Prices, sellers are coming out, sellers are dying out once it hits the demand level. Sellers dying out once it reaches the demand level. Same thing here. Once it broke supply, big volume on buyers, and then it retests back down, we want the volume to die off because sellers are trying to get in control with that pullback, with that retest. But we're not going to let them. That's why we want to see volume die down. We want to see buyers not let them do that, not let them take control, okay? But it enters the zone, though. It enters the retest zone, okay? Price picks back up with the buyers taking it above the zone once again. Sellers tried to take control. Buyers didn't let them. They said, no, fuck off. We're going to take this even more. Okay. And then you want to look for a candle closure above the zone with a close above the previous lower high created on the 15 to 30 minute time frame. This just gives you better confidence. Doesn't necessarily say you have to go for it, but the more confidence you have, the better you are at the trade. Okay, the better possibility of making that a good trade you can have, basically. And then again, stop below the supply zone. This is what I mean. This is exactly what I mean. All right, look here. Supply zone broke above the supply zone. Buyers are in control, so we can even look from the checklist that we have. Was it in the supply zone? Check. With 4-hour trend or an uptrend? Check. Volume increases as price approaches and breaks zone. Check. Right? You see here. Check. Right? It broke and volume increased. Nope. My bad. Price retests zone. Enter zone with volume dying off. We saw here. Oh, sellers try to take control. Consolidating. But they try to take control. They almost did, but then they consolidated a little bit. Then they finally hit back the zone, right? They finally retest the zone again. With volume dying off. Check. Price picks back up with buyers taking it above the zone once again. Da-da-da. 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 Check. All right, 3 times check, okay? Let's see here. Candle closure above zone with the close above previous high or low created on the 15 to 30 minute time frame. All right. All we're looking most importantly is a candle closure above the zone. This has a higher confluence. Da-da-da. Check. All right. Check. 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 All right. Stop below zone. Stop below zone. So what happens again? People say like, oh, but there's 3 opportunities to get in. Yes, there's 3 opportunities to get in, and all opportunities will still make you money, because guess what? Your stop loss is below the zone. If your stop loss was here, yeah, you might get ticked off. You might get wicked off your stop. But why would your stop be here? There's no point for your stop to be here. Your point for your stop loss is to be below the zone you created. That's the best way you can actually get a true win percentage, is sticking to your plan. So create your zone, right? And once you create your zone, look for a stop below that zone. So even if you do get into here, even if you do get into here, you're still going to make the money, okay? So all of this still works out even if you have price coming back down. It's retesting more than once. Okay, that doesn't matter, man. It doesn't matter. You're still going to make money because your stop is below the zone, or it should be below the zone. Then you put your take profit wherever you want, you know. Break a retest, break, stop loss here, take profit here. Wherever you want to put your take profit, that's actually a valid level, but also make sure it's in according to your stop loss. Your win percentage, I believe the 60% or more it would deem for you to have a 1-to-1 risk to reward ratio. Okay, I believe that. I'm pretty sure if you have a win rate of 60% or more, that's when you can have a 1-to-1 risk to reward ratio. And what that means, like I said, is basically that your stop loss and your take profit is around 1-to-1, right? And you can go to TradingView. You can see exactly what that means when you put your stop loss and take profit. You see a 1-to-1 risk to reward ratio. Okay, and 1-to-2 is basically the amount of money you're going to lose is basically 1 compared to, or the amount of money you're going to make is twice compared to the amount of money you're going to lose on your stop versus your take profit. Look for a 2-to-1 risk to reward ratio, or a 3-to-1 risk to reward ratio. You know, look for higher ones, obviously, and I do the same thing too. But my win percentage is well off. I can do a 1-to-1 risk to reward ratio, but I doesn't say I normally do it, because I don't normally do that. Okay, even though I have a higher win percentage or win rate, I still don't do it. So I wouldn't want you guys to do it as well. But I'm not going to say it's entirely wrong, but just look to have a valid stop loss and a valid take profit. That's the most important part. That's the break and retest of supply. So you've seen demand bounces. You just go in a demand zone, 4-hour trend, volume is pulling back, sellers are coming down, sellers are picking up, but then they're dying off as you reach the demand zone. Candle closure above the zone, stop below the zone. You're not going to get wicked off in this trade if your stop was below the zone. Then you take it above to take profit level wherever you deem a valid take profit level to be. Maybe here, you know, maybe at the high right up there. Depends. Liquidity sweep. Almost same thing as demand bounce, but you just have a liquidity sweep right here. That's a little bit different to take it up, right? It's still in the demand zone, and it's you're still taking it long. You still have a stop below the zone, but in reality, it's even more than that. It's below the liquidity level. You still have all that. It's just a little bit of tweaks, all right? A little bit of tweaks when it comes to demand bounce and the liquidity sweep. Breaking retest of supply, just a little bit different in terms of that we're in a supply now, but we're still going long. We still want to take the market up. We just break. Buyers are pretty strong with that break of the supply zone. Then we retest back down. Sellers start to look like they're picking control up, but then they get back to the zone and they're dying off. And then you look for buyers to take back control and then come back up above the zone and close above the zone. And that's when you take your trade, get a take profit at the high here maybe, and then a stop loss below the zone. Pretty simple. Now the breakout of supply. Why I did this after the break and retest of supply, because you would assume, why don't you use the break out of supply and then the break and retest? Because I want to show you what was the most important one and was the safest one. This one, not as safe. Still works, not as safe, okay? It's the same as the break and retest of supply minus the retest of a supply. So the higher time frame shows a really clear trend in that direction, okay? You need to have strong confluences when you're doing just a breakout of supply because it's a lot riskier, okay? So make sure that the higher time frames are showing a really clear trend in that direction. If you have even 1 ounce of skepticism on that, don't do it. Wait for a retest, okay? It's a riskier trade. It's a riskier trade because you're not getting that retest back down. It's a riskier trade because once you get that retest back down, your stop is done. That's exactly why I'm saying that. But it works. If you have a clear trend, a clear showing of trend in that direction, let's say you're going out of supply, obviously, so you're going long, and you're seeing volume just picking up like it's just going to keep on going. It's a riskier trade, but it might keep on going. That's the problem, though. It might keep on going. This isn't an A+ setup in the sleeves. This is like maybe a B-, maybe even a C+ setup at the end of the day because it's so risky. But it's a riskier trade, but that's why you align it with a good stop. Stop below that breakout line. So if that breakout does go, but it retests back down, you're good because you're keeping the risk tight. You might even get less money. Maybe put less money into that if you're doing this to breakout. Keep that risk tight right below that breakout line. Make it safer. Even though it's a riskier trade, you can still make it safer. What it means here, this is the breakout basically. See strong confluence, clear direction, and just breaks out and keeps going. So at the end of the day, it's not retesting, is it? So that's what I'm trying to say is if you're looking for just a breakout, make sure it's a clear breakout. Stop below that breakout. And the breakout is the high of the supply zone. You're wanting your stop to be below this level. Once it breaks out and closes, keep your stop below that breakout. Because once it closes below that breakout and you put your stop here, it's too high of a risk for you. So just keep it here, okay? Keep it below here. And if it comes back down, it's not a breakout trade anymore. It's probably turning into a break and retest, all right? So very simple. One of the riskier ones to do for sure. Probably the riskiest one. So I'm just saying if you want to do it, understand where it's categorized with all of these. All of these are like B+, A+, A setups, except for the breakout. It's definitely below B, I would say, because it's so risky, but you can make it safer. Keep that stop tight, below that breakout line. Maybe put less money into it and understand that the trade might not go your way because it might turn into a break and a retest. Then we have a squeeze for longs. And why I'm saying squeeze for longs is that maybe the squeeze isn't in a demand zone. Maybe I'm saying, because I told you, like, you only want to take a trades in demand and supply zones, but maybe the squeezes aren't in demand or supply zone, but it's still looking good. You know what I mean? Squeezes you're looking at a little bit of a triangle trend going in from the higher lows, or the highs and the lows, basically. So you see here the lows of the bounce level of the bounces, right? You have one right here and you have one right here. You need 2 or more, by the way, for it to be classified as a squeeze, obviously. Then you have a high rejection right here from this high right here, and that creates a little bit of a, how to say it, like a little bit of a triangle, as you can see here, like a pizza slice, whatever you want to call it, you see here. And once it's in this, if it breaks a certain level, it's going to break with momentum, with juice, right? And like I'm saying in terms of this one and the breakout, not only do you keep the stop tight, also keep the take profit tight, okay? So keep that tight, and definitely keep the squeeze take profit tight. because it might come down and inverse. This is a perfect indication. Once it does break out this level, right? Keep that tight, and then the stop is a little bit different. You're gonna want to signify a stop when it comes to squeezes based off the trend. Okay, so if it does squeeze back up, you're gonna want to look for a stop to go down into whatever low it created while it was in that trade previously before, like you see here. This was the low that created when it squeezed back up, right? So you're going to want to look for what low it had, right? What was the lowest low it had, and then you want to put your stop right at that low, okay? Understand it's a very risky trade because it could always hit your stop. Squeezes are more of a dangerous game if you're looking for higher profits or longer profits when you're swing trading. You really don't want to look for that kind of stuff. This is the 4-hour time frame right now, so that's why it's a little bit different. But once you're actually making the trade, you're looking at the 30-minute to 1 hour time frame, and then you'll see it's a little bit different on the market, on the trade, how it looks like and everything. But once it breaks that squeeze, that's when you're looking for that long. You're looking for that break of the squeeze. You're not looking for that close, right? You're not looking for that close. You're looking for a significant break, because once it goes, because squeezes are a thing for a reason. Once it goes near these trend lines and it actually clearly breaks them, it's going to have a nice little squeeze pop up or pop down for squeezes for shorts. But now this is squeeze for longs. It's gonna have that nice pop up and a nice little. It's kind of like, I think, a pop up, like a jump up before it comes back down, right? Before it comes crashing back down. That's why it's a little bit riskier, but it's really nice, right? I would classify this even below B, maybe a B trade, right? Because once it does clearly break that trend, right? That squeeze level, that squeeze triangle, I guess you call it, that I have, breaks back up, pops back up there, and you can clearly see that it does give you a nice little lucrative trade. Make sure your stop is clearly defined. At the end of the day, I put it at that low in that triangle. I put it at that low. But at the end of the day, it's how you want to look at it when you put your stop on this. I'm showing you the most safest trades first, or setups first, and that is the demand bounce. All right, I gave you exactly what you need to find for that demand bounce every single time. Liquidity sweep, exactly how to find the liquidity sweep and take it every single time. And then the break and retest, exactly how to find the break and retest of supply for longs every single time. And then I showed you the two riskier setups that still work, but you need to be cautious about. That's the breakout of supply. You have to be cautious. And this is a squeeze for longs, okay? You have to be cautious about it, all right? Because you can get that nice little squeeze back up, and then you have to be cautious of where you're taking profit. If you're too greedy when it comes to money at the moment, and you know that, don't do squeezes, don't do breakouts. It's just going to become way worse on you, all right? So just how you are psychologically, and if you know that, what kind of person you are, will deem whether you can do these two setups for longs. But if you're just starting out, especially if you're new to trading and you want to learn my strategy, you want to learn a strategy, don't do risky setups. Don't do breakout of supply. Don't do squeeze for longs. Stick with these three setups, which gives you a lot of opportunity. Stick with the demand bounce for longs. Stick with the liquidity sweeps for longs. Stick with the break and retest supply for longs. All right, that's three setups, 3A setups that you can have that will make you money consistently in the market. And you're swing trading, which means you only need technically one trade a week to become profitable and make money when it comes to swing trading. 2, maybe 3 max. All right, you're swing trading. You don't need to be stuck in the computer all day long taking like 10, 20 trades a time, okay? Now let's look into shorts. So with shorts, we have kind of the same basis or aspects when it comes to longing, but now it's just different because you're trying to sell the market. So you're still using demand and you're still using supply for all of this, but you're using it in a different way. So we have the supply reject. We have the breakout of demand. We have the break and retest of demand. We have the liquidity sweep as supply. So as you can kind of see here, it's all like just opposite. It's reversed basically, which makes it way easier, because once you know one, it makes it way easier for you to know the other. But this is how you do selling the market for shorts. What's a supply reject? So supply reject, you're in a supply zone. It has the supply in the name, right? You're in a supply zone. Number 2, are you with the 4-hour trend? All right, is it a bear market? Sure, let's check it off, right? Number 3, is volume dying off as price approaches the zone, the supply zone? That means less interest on the buyer side as we make higher prices. All right, you see it's reversing a lot. Is there a candle reject at that zone, right? I don't want it to close above zone if I'm looking for a supply reject, okay? With a close below the zone, right? And you can even do it on the 15 to 30 minute time frame where you're actually taking the trade. Because when you want it to close below the zone, you're looking to take the trade on the 15 to 30 minute time frame when you're swing trading. That gives you the best possible entry. You want that sniper entry, right? You want that sniper entry to make sure you have the best possible entry and your stop is perfect and your take profit is perfect. You're not always going to get it, but it's always good to try. Every single time, try to get that perfect entry. Stop below the zone. Wait, stop above the supply zone. Sorry, I'm thinking about demands. Stop above the supply zone, all right, because you're trying to short the market off. You want to stop above that supply zone so that if it does go above it, that means it smack that supply zone out, and chances are price is still going to go up and buyers are still in control. This is a supply zone right here. As you can see here, it went into the zone. Perfect rejects, supply rejects are ones that just wick the bottom of the zone and come back down. I love those because that's just, it's just perfect for me, right? But this, at the end of the day, not perfect, but it still works. It's supply reject, right? Supply zone, this is the top of the supply zone. This is the bottom of the supply zone. Once it goes back, it went back in there, right? And once it went back into the zone, it didn't close above the zone. It just went into the zone, and then it closed below the zone. And that's when I take my trade to take it short, right down to a certain take profit level. It could be here, right? It could be here, wherever you deem necessary your take profit levels are compared to your stop level. Because your stop level should always be the same. Stop loss, right above that zone when it comes to supply rejects, okay? Right above the zone. Not in the zone, not right at the top of the zone, right above it. Because it could always wick this level here of the zone, like this. It could always wick it. You want to make sure it's right above that zone, okay? That's supply reject. Pretty simple in terms that you're in a supply zone with the 4-hour trend. It's in a downtrend, right? And then volume dies off as price approaches zone, so buyers are kind of in control as we go up, but they're not strong, right? And then that means there's less interest on the buyers as we make those higher prices. And once it does reach that zone, once it does get into that zone or reject that zone, that means the buyers aren't in control anymore. Sellers took control, okay? And then it goes in the zone or rejects the zone, and then it closes below that zone on the 15 to 30 minute time frame. And then that's when you put in your trade, put your stop above here, your take profit like right here or right here, and you enter the trade somewhere around this level here. Now we look at liquidity sweep at supply. Same thing as the liquidity sweep at demand, just reversed. It's in a supply zone. Is it with the 4-hour trend? That means, are we going in a downtrend overall in the market? Is volume dying off as price approaches the zone? That means we're making less interest as we make higher prices. Is price sweeping liquidity above without closing above on the 15 to 30 minute time frame, right? Are we just sweeping it? Sweeping means going above it but not closing above that liquidity, okay? And then is candle closure below the zone with a close in the 15 to 30 minute time frame, and is a stop above the highest point of liquidity. This is all a checklist, by the way. Everything you see here is a checklist of how it should be when you're looking at the trade. You must mark every single thing here to make sure that you should take that trade. If one thing is off, don't fucking touch it. You're a beginner at trading. You're not experienced, especially if it's not with the 4-hour time frame. I would think this is the only thing, even if you are an experienced trader, this is the only thing that you could take away, all right? Going against the trend, sure. But as long as you're a beginner trader, as long as you're not profitable yet, you should have all this shit checked off before you even think of taking that trade, all right? Liquidity sweep up. Pretty simple. Like I said, I keep mine a horizontal line. My liquidity sweep is a price level, okay? High liquidity sweep right here. Highest liquidity sweep, previous liquidity. This is the liquidity sweep. It's sub liquidity. Did not close above previous liquidity, right? Sub liquidity. Then it closed below it. You take your trade, and for it to go down for shorts. As you can see here, this is the highest point of liquidity. This is where your stop should be, okay? Don't put your stop here. Don't put your stop here, because look what happened to this candle. It went above it. Still, it might go above it. It's not a perfect, it's not a holy grail. There's no strategy that's a holy grail, okay, guys? Understand that it might not look perfect all the time. Your trade might not look perfect all the time, all right? But as long as you have these certain parameters set, like a stop above the highest point of liquidity set, you're good to go. Your stop is here, and you're going to make money, right? Put your take profit at a certain high, or sorry, a certain low, a certain lower low, whatever it is, wherever a certain valid level you take profit, and make sure your stop is always at the right level. Your take profit will always be a different level, but your stop should always be the same with whatever setup you have. Understand? Now you have the break and retest of demand. It's pretty simple. Just again, the reverse of the breaking retest of supply. Are you in a demand zone? Are you with the 4-hour trend? Is volume increasing as price is approaching and breaks the zone? That means more interest as we make those lower prices. Then price retest zone. It does enter the zone, but volume dies off. Buyers aren't in control as as buyers are retesting the zone. Does price pick back up, right, when sellers are taking it below the zone once again, right? So this price picks back up, down, or price picks back down, basically, right, with sellers taking it below the zone once again. They're completely shutting off the buyers with them retesting the zone by saying, all right, you can go back into the zone, but you're not going to go above it. You're just going to retest it. You're going to revisit it for a little bit, and then we're going to take it back down again. Sellers are now in control once they go below the zone and the candle closure below the zone, all right, with a close created below on 15 to 30 minute time frame. Stop above the demand zone. Let's see here, right? We have a support basically, or a demand, or you can look at it as support, resistance, or demand and supply, basically. Again, I count these all. It's all the same things. It's really just relative to how you look at it, man. Break of the demand zone. Break of the demand zone. Push back up to retest the demand zone. Buyers took control. Sellers took control as they broke. Sellers were in control and they were strong as they broke the demand zone. But then buyers took back control. But they were still weak. There's a difference between buyers being in control and being strong, and versus buyers just being in control but still being weak. Because they were weak as they entered and retested the zone again. And you can see here, buyers died out and sellers took control, and then that's when you enter the trade. When sellers take control, right back down, right? And then you want to take your put your stop loss right below this level right here, right above the demand zone right here, making sure that you won't get wicked out of the trade, and then you take it for shorts down, right? And a little different thing that I can show you that I meant to put this picture on here so you can actually see what I mean is, again, trades aren't always going to be perfect, right? You would love for a candle closure to be like right here when it retests zone and comes back down so you can take a trade and get more profit off of it. But what happens if it doesn't? This is what you do, all right? Don't panic, all right? This is what you do. But if you want to completely miss this trade because of that, go ahead. It's much safer. You're much safer off doing that. But if you want to still take the trade, this is what you should do. You can see here, right? Look at this low that it created, right? Because it did pick it back up and then it pulled back down, but then this low got created and then it went back up to retest the zone. Look at this low that was created and think of this, right? If price is breaking down this low, chances are it's a very good indication that it's going to keep going down. And if it's not closing close to that zone, once it retests that zone, then it's going to continue going and it might close more than that. And that means that risk isn't going to be properly aligned. So if it closes here and you try to take trade here, risk is not properly aligned. That's why you're going to try to find a way on how to do so that risk is properly aligned, especially if you have a win percentage that requires you to have a 2-to-1 risk to reward ratio. Is making sure that you take the trade at a certain price level. So if it does break this low, I would take the trade right here. If it does reach the zone and break it, I'm gonna take a trade right here. Then I'm gonna put my stop right above the zone, and then I'm gonna put my take profit at a certain signified level or a certain VAD level. Coming in. Obviously, you can't see here, but going back all the way into going past the times, you can see maybe a certain VAD level, like a couple of weeks, couple of days, or a couple of months, depending on what time frame you're at. Then you put it at a certain level, a certain valid price level. Okay. And once you do that, understand it won't always go your way. It's trading is always how can you work with the situation that you have, right? Because you're looking at the overall market, you're looking at political events, you're looking at economical events, economical data, all that, political data, all of that, and you're trying to trade in the best way possible. That's why you should always stick with your setup, stick with your strategy, stick with your idea, stick with your plan, stick with your pre-checklists, all of that. But understand that things aren't always going to go your way. How I would say that is expect shit to hit the fan, basically, guys, all right? You have a plan, right? Go according to your plan. Expect your plan not to go all the way according to your plan, and rework it, tweak it, all right? That's what you do. You have a plan and you stick with that plan. You assume to stick with that plan. But if it's not gonna go, if shit hits the fan, if things go awry, just understand that you have to tweak it, right? You're in a battle right now. You have to learn how to adapt to situations all the time. That doesn't mean go completely away from your plan. You should always have the plan, always stick with it at the best, right? But let's say in this scenario, right, your plan was to take a trade once it closed below the zone, right? You're not tweaking your plan like you're just, okay, you're going to take a trade while you're in the zone. It's still retesting. That's completely going away from the plan. When I say tweak it, I mean, all right, sellers took control after buyers retested that zone and price came down with sellers, right? But it didn't close really close to the zone. It closed right here. So I'm looking at beforehand, right? I'm looking at this candle beforehand. If it keeps going down and it breaks this low here, I'm going to take a trade right here. This is the best possible outcome I can have, to have maybe a 1 or 2 to risk 2 to 1 risk reward ratio, because I'm putting my stop still here and I'm putting my take profit somewhere at a valid level here. I need to put my take profit at a 2 times what my stop is, right? That's a 2 to 1 risk reward ratio. So make sure you can adapt to the market overall. Stick to your plan. Always stick to your plan. This isn't going away from your plan. This is just tweaking it because things aren't going all the way according to your plan, right? Like I said, completely throwing away the plan and making a new one is saying, hey, price retested all the way here. I'm just going to take the trade at that retest, still in the zone. I'm not going to take the trade, and I'm not going to wait for sellers to take back control and price to go below the zone. I'm not going to wait for that. That's completely throwing away the plan and doing whatever the fuck you want, right? That's being stupid. That's ego trading, or whatever you can call it, right? What is just tweaking the plan is just saying, hey, I'm going to wait for price to go back to zone, and it did. But if it goes too below the zone, I'm going to have a significant point where I'm going to see, all right, this is the low of that zone. All right, I'm going to make sure that at this low of the zone, if it does cross here and doesn't close yet, I'm going to take the trade right here, and I'm putting my stop right above the zone like I should. Always make sure that's the same thing, right? That's in the plan. It has to be stuck with that. And then I'm going to take my take profit level at a 2 to 1 risk reward ratio and make sure it's a valid level. I have all that set up. I don't have anything to worry about, all right? I don't have anything to worry about. Always make sure you're putting in the right amount of money you can have too, right? It should be however much money you put in should be exactly what you're willing to lose at that stop level, right? At the stop loss. Make sure it's always about how much money you're putting in. Sure, look at it in terms of ticks, pips, and price levels on the market to see where your stop loss is and see where your take profit is. Absolutely. Don't look at the money when it comes to that. But look at the money when it comes to how much are you willing to lose at your stop loss, though. That's the whole point of it. You can put your stop loss here. It always should be here. But how much money are you putting in the trade even? That's the important part, too. Understand how much money you're putting in the trade. You can put in $10,000 in this trade and put your stop loss here, and you're losing, let's say, $3,000. Do you want to lose? Are you okay with losing $3,000? Are you? If you're not, make sure you're putting in less money. That's the whole point of it. The first thing you should do, and I hate people say don't look at the money part of it. If you're trading for real, look at the money part of it in terms of how much you're willing to lose at that stop loss level, especially when you're swing trading, commodities, indices, forex pairs, stuff like that. Look at what you're trading, all right? Look at how much you're losing when you're going to trade. If I'm putting here 10K here, I want to lose 3K. So my stop loss here makes me lose 3K. Perfect, right? Because I can make, let's say, 6K, right? I can make twice that. It's exactly what I'm looking at. But always look at your stop loss like it's a price level, right? Above the zone. Always look at your take profit like it's a ratio when it comes to your risk to reward ratio or a valid level, right? Always look at it like that, okay? Pretty simple here. Now we got the breakout of demand, the more riskier trades. Same as the break and retest of supply, minus the retest. Make sure that the higher time frames show a really clear trend in that direction. I can't emphasize that enough. If it doesn't, if you have even the slightest bit of skepticism that it's not, don't take it. It's a riskier trade. That's the reason. Stop above that breakout line. Like here, nice clear breakout of this demand level, right? Stop above that level, above that breakout level, right? And then you take it and you put your take profit to a certain valid trade level, certain valid level. And why I say that is because if you're looking for a breakout, you're not looking for price to come back above this breakout line or this demand, this lowest of demand level, right? You're not looking for price to come back down, come back up to it if you're taking a short off a breakout. You're looking for price to just continue. It's a continuation play, basically. A breakout trade is a continuation trade, okay? So that's why you can have a stop right above this line. Because if it does go right above that breakout line, right, in your demand, right above the demand level for the breakout line, what happens? It turns into a what? A retest of demand. Simple, all right? Look at it. If it goes back up, basically also in supply, when you're looking for the breakout of supply for longs, if it retests supply, like here, let's say it retests here, what is it again? It's a retest. It's a breakout and retest. So you're missing the retest. So again, if you're looking for that breakout, if you can see it's significantly going to go for a breakout like it did here, right? Look for that stop to be right above that breakout level on demand, right? If you're going short with the breakout. And because if buyers pick back up, that means, again, what's happening? It might be a retest of the demand level, okay? Very simple here. Very simple. It's just a riskier trade because you're not getting that retest back there. Basically, breakouts are riskier because there's no retest. Retests help traders a lot in understanding, are sellers or are buyers really in control, right? I want that retest because I want to see, are the sellers, are the buyers really in control? Let's say we want sellers in control with the break and retest of demand, right? I want to see, are sellers really in control right now, all right? Or is it just a fake out, right? If I break here and I'm looking for that retest, I want to see that retest because I want to see, I know buyers are probably at some point going to pick back up. I want to see, are they really in control? Because I'm swing trading. I'm looking for that higher time frame swing play, right? I'm not looking for a, on the 5-minute time frame, the 1-minute time frame trades. I'm looking for the 30-minute to an hour time frame trades to look at the 4-hour time frame to see my levels, basically, right? So I'm not looking for that little bit of a trade. I'm looking for that longer trade. That's why I'm swing trading. So I want to see, are for a demand break and retest, are sellers really in control? Because I want to see them break it. Then I want to see, I know buyers are going to try to take control at some point. So I want to see that break. The probability is buyers are going to try to take control at some point. So after I see that break, I want to wait for buyers to start to take control. Then I want to see, are they going to revisit my zone again? If they do, it's perfect. Once they revisit my zone, I'm going to look, are sellers going to take back control? Because once it breaks this zone, once it breaks back up to this demand zone, I know that buyers are too strong at this moment. I know it was more of a fake out. So I'm waiting. Once they get into that zone, sellers take back control. Perfect. Close below that zone or go below that zone to a certain level. Perfect. I'm taking this down with sellers because I know sellers are still going to be controlled at a certain level. I'm just trying to make money from the market. I'm not trying to move the market. Again, you can't move the market. I'm trying to ride the wave. I'm trying to see where these hedge funds, where these big investors are taking the market. Same thing with the breakout of demand, all right? It's just a riskier trade, but I'm trying to see a big indication that the higher time frames show a really, really clear trend in that direction. Really clear trend in the downtrend, all right? Really clear downtrend. And once they do break that, I want to see, oh wait, I'm keeping my stop tight because this is a really clear break. I want a quick trade. I want a quicker trade. And you especially do breakouts when you're either at all-time lows, but more importantly when you're at all-time highs, because the market continuously goes up basically, right? So when you're at all-time highs especially, you're more looking for that breakout. It's a riskier trade, yes, but if your risk is aligned and your stop is tight, it's not that bad, all right? It's really not that bad if you're an experienced and profitable trader. If you're not, don't even look at this, right? Look for a sell-off in the market if you're at all-time highs like we are now. Man, I'm a profitable trader. I've been trading for over 8 years, swing trading for over 8 years. I'm still waiting for that sell-off to happen, man. I'm still waiting for gold to just push back down so we can actually get some clear indication of levels, man. I'm still waiting for S&P 500 to do the same thing. I need sell-offs. I need corrections, my guy. I need retraces back down. But breakouts aren't a bad way to go about that when you are at all-time high because you can get that quicker trade. Because once you get at all-time highs, you're going to try to take profit above all-time highs. You don't know where price is going to go above all-time highs. It's you just don't know. You're just predicting levels, okay? So breakouts are a very good way to do that because if it does break out, it might not retest back down. It might just keep going out. So that's why people use a lot of breakouts. They use it closer to all-time highs. But yeah, it's the same thing. It's just missing that retest. It's missing that safety net. This is a squeeze for shorts. Like I said, this is a better indication of a swings for shorts. You got that swing. So you got that squeeze. You got to see the higher highs or the highs created, the lower high right here. You see how it's a nice trend. And you need 2 or more, obviously. And then you have these lows created here. One here, and then you're going to want to match it. You're going to want to match these two. At that point, once you squeeze, you see, all right, I want to see a clear break. I want to see a high momentum, high volume break. As you can see here, it happened a little bit here, obviously, right? But at the end of the day, this wasn't a clear momentum move. You can clearly see you need a clear sell off. You need a clear big handle, man. Big handle to just keep on moving. Once it keeps on moving, once you see volume just going up to, this is where volume is very important as well, and VWAP as well. This is where your indicators start doing its job. Is you want to see a clear move back, a clear move down, or a clear move up if you're doing squeeze for longs. But a big move, a strong move, buyers are in control. If you look at level 2 even better, you want to see breaks. You want to see a big break, big sellers taking control, a lot of sellers. That's when squeezes work for you in the best case scenario, right? If you're just looking at candles, my guy, you're not going to get squeezes that much, right? This is where level 2 data, real market time data, really helps a lot in looking to see where the squeeze is actually squeezing, right? Where you're going to see that pop down or up depending on where you're squeezing to understand that, right? But when it comes to squeezes, you're looking at a trend. When I looked at this trend, right, this was a downtrend. I'm looking for a squeeze down. That's the whole point of it. If you're looking for a squeeze, go with the trend. And if it's not with the trend, chances are it's not going to squeeze that direction, okay? And I just think it's a very good way to look about it when you're not, when the market really, or price isn't really close to your supply or demand zone. I think it's a very good way of taking a trade or taking some profit off of the market when it's not close to a demand or a supply or whatever zone you have, right? I've used these so many times. They are riskier, but they definitely heed a lot of benefits, because at the end of the day, if I'm also looking at real-time market data, I'm seeing exactly how much volume is going in on this squeeze. I know I can get a nice play off this. I know if I'm in a downtrend and I see a nice little squeeze potential like this, I'm looking for it to cross the low of that trend, not the high trend line, the lower trend line here. I'm looking for it to reach it and see volume, big volume from sellers coming down. Then I'm in that trade. I'm taking it a nice take profit level, probably around right here like I did here, and it was perfect take profit level to do that actually. And then obviously I'm taking my stop right here. As I said on the other one, squeeze for longs, I put my stop at the high, right, the nearest high. This is the nearest low for squeezes. So I'm looking at right here to take my stop, and then I'm taking this bitch down, right, down. And that's what squeezes are, man. Squeezes are very beneficial, especially when you're kind of in a range between zones, supply and demand zones. And it does heed a lot of benefits for you. But again, like I said, breakout and squeezes, last resorts. I gave you 3 perfect setups when it comes to shorting. Perfect setups. Supply reject. Perfect setup, right? Safe setup, right? You're basically just waiting for price to go back to your supply zone and and reject it to come back down and close and take it off short. Perfect, safe, one of the safest setups you can have. Liquidity to supply. Again, one of the safest setups you can have. I'm waiting for liquidity to be swept, putting my stop above that liquidity, and waiting for a price to close down below that liquidity level in that zone. Then I'm taking it down. All right, I'm taking it down. That's a very safe setup. Break and retest of demand for shorts, very safe setup. All like the longs, all my long setups, those 3 safe setups. These 3 for shorts, safe setups. I'm looking for that break, but I'm looking also for that retest, so buyers, I can see whether buyers or sellers are in control at that moment, because once it reaches that zone, once it retests back that zone, I want to see sellers take control because it's a downtrend, and I want to see sellers take control because I want to go short in a downtrend. I want to go short in a bearish market most of the time. And then if it does, perfect. I'm looking for sellers to take control back below the zone, and I'm taking the trade. Whether it's a perfect trade because it closes right below that zone and I can have a tighter stop, awesome. Or if it's not as perfect as a trade and price just keeps going down a little bit, I want to look for that low, that previous low it can create, the nearest low it creates, and I'm taking that trade right here. It's an open trade, so I can take it below because I want to make sure that my stop is good enough to where my take profit can be. I want a valid take profit. That's why I looked at here. This is the lowest created, but with my stop and my valid take profit, it has me a either 1-to-1 risk to reward ratio if you have a 60% win rate or more, or it has a 1-to-2 risk to reward ratio if you have a below 60% win rate. All right. So at that point, these are the safest steps you can have. Look at breakout of demand. Look at squeezes for shorts as just ideas, right? Especially if you're profitable, look for ideas like that. I wouldn't say make this most of your trading. I use squeeze a lot, right? But at the end of the day, I use breakouts a lot, right? That doesn't mean that I use it most, because most of my trades come from either liquidity sweeps, rejects, bounces, and break and retests, right? Most of my trades, swing trades, come from that because it's the safest bet. Market is dangerous. Market is risky. Align with that, and you got yourself a pretty good plan. Okay, a pretty good system in place. Now, let's look at basically a pre-market plan. Okay, and this is basically the last part of it until we get into the psychology part, the mindset part. This is just the pre-market plan that you might want to create for yourself. This is kind of an idea of how you can go about it. This is how I go about it most of the day. So let's say on this chart right here, right? We currently have a 4-hour. Let's say this is a chart of gold. All right. We currently have a 4-hour bullish market. The 30-minute trend is to the upside, all right, and we are also seeing volume die off at the current price level. You can see here, this is a bullish market. We're on the 4-hour bullish market trend. The 30-minute trend is to the upside, so that means we're seeing volume die off at the current price level. This is the current price level. We broke this supply, all right? We broke up in supply at 55.86. But we have no red folder news today, okay? You can see volume died off here. Volume might be retesting back the zone, right? So we broke up in supply. We have no red folder news today. Let's say it's like a Monday, basically, most of the time. We have no red folder news today. We have no data today to come out. Might be a pretty slow market, might not, we'll see, right? It's still a safe bet because there's no news. If price retraces back down to the daily high at 55.86, which is right here, I will look to go long due to the 4-hour trend being a bullish, right, being an uptrend, and the 30-minute trend fading down to my demand. Okay, I will place my stop where at the low of the zone, and I'll look to take full TP at 5600, which is the next valid take profit level. Boom, that's your pre-market plan. It's literally that simple. You have your setups. All these are your setups. You have all these as your setups. You have your shorts. You have your long setups. You have all of these, and you have your basics. You have your basic ideas, and you have your technical analysis. You have everything you need to now create a plan. Go ahead, create a plan for you. Create a plan next day. Look at the market today and make a plan for you, basically, right? Make a plan of what you're looking at in the market and what you'll do. You have to have everything in accordance to yourself, right? Everything should be made before you even enter the trade, before the market even opens at sometimes, right? Before the New York market opens, let's say you only trade futures or options or forex, whatever you want. Before anything, make sure you have a pre-market plan before you get into any trade. This is an easy pre-market plan, and that's the point. It doesn't have to be hard. Make it simple. You keep it simple, you're much better off, right? So, like I said, this is very simple. You have your same stop loss and you have your full TP at a certain valid level. Always keep your stop loss the same. Wherever setup you have, make sure it's a valid stop loss with that setup. And look at news. Look at the economical data. Look at the political data. Look at what's going on in the market. Look at what's going on in the economy. Look at what's going on in the government and politics. All of that is very important because it can drive up or it could drive down price. Okay? Very simple pre-market plan. This is how it should be. I want you to go and make your pre-market plans as well. You don't even have to watch this whole video will be in one part, like in one thing. So the first video and the last video all the way into this video, there's 3 parts. It's all going to be in one video, one YouTube video for you, like you can obviously see here. So if you want to pause it at all and just do your thing, like take it in small steps, small little parts, go ahead. That's perfectly fine with you. That's why I made it into different parts. I made the basics and the technical analysis part, then I made the strategy part, and now I'm going to make the psychological and mindset part. They're all supposed to be different because they're all at different levels of where you are at. I want you, before you get into the psychology part, the mindset part, to have it down. Have the pre-market plan, have the strategy part down, have all of it down. Once you have all this down, then you can move on to the psychological part and the mindset part. So have the basics down. Have the technical analysis part of it down. Know where to find your supply and demand zones. Know what setups you can have, right, that I can show you. Know your strategies. Know all of that. Know how to make a pre-market plan. Know how to look at all of the grit, right? All the things like when you're in the trenches. Know how to look at all of that before you can even get into the psychology part. Because like I told you, if you just skip to the psychological part, the mindset part, you're not going to do that good because you don't have all of the back end stuff down yet. Okay, so once you get all this down, come back to the video, right? If you want to watch the whole video all in one just to get an understanding of it too, you can do that. If you really want to learn how to trade, my opinion is for you to do it all in small parts. That's why I have it in small parts like this. So yeah, just go ahead and do all that. Come back to this video because then we're going to go into the psychological part. That's the fun part. That's the part where I just talk to you basically, and I just show you exactly how you should go about trading, because it's a lonely road. Trading is a lonely road. It's good to have a community behind you. It's good to have a strong mind. It's going to be strong willfully, and it's going to be disciplined as well. And then once you're able to finally go through the pain when it comes to trading, you'll be so much better off, and that's where profitability and freedom comes in. All right, but first do all that, and then we'll move on to the next part of the video. All right, guys, now let's talk about self-discipline. Now, this is the first part of the last part of the video, and we're going to talk about what's really going on behind a trader's mind. A lot of things when it comes to mindset psychologically, but discipline or self-discipline is one of the most important things. To be a trader, you have to be very, very disciplined and very, very patient. Now, there's not a lot of things you can get away with in life without being disciplined. And trading and making money is one of those things. Whether you're trying to open up a business, whether you're trying to do something for your job or trying to get a bonus or get a pay raise at your job, whatever it is, those all require discipline, because you have to work harder to get to those points. You have to study harder as well, especially as a trader, to get to that point. And if you don't have the discipline, if you don't have the self-discipline, the correct mindset to go about it, you're not going to get very far in that trajectory. Now, one thing I will say is that this seems like the easiest part of everything when it comes to learning how to trade and figuring out how to become the best possible person to become profitable. This seems like the easiest part of the entire course, but bear in mind, it's not the easiest part of the entire course. It's probably the hardest part of the entire course. Why is that? Because where most traders fail, where most traders hit that rough spot right before they become profitable, is in the psychology part. It's the over trading, it's the revenge trading, it's the thinking you're better than you are, it's the ego trading, it's the not being confident enough to get into trades type of person, okay? That is where most traders fail. They don't fail in the point, most of them, at least there are some obviously, but most of them don't fail in the point where they don't know what they're doing when it comes to trading. They all do. I've had people I've taught that have been trading for just as much as I have, that know trading to the T. They know how to find zones. They know what supply and demand are. They know what real-time market data is. They know how to look at that and put it into their trading system, their trading plan. They know all of that. They know the basics of trading. They know everything. Some of them maybe even know better than me, okay? But the one thing that they don't have, that I have, is the discipline and the patience enough to look into my failures and work on it and tweak it, okay? So that is something that I think, even though you might be really good or you might know everything about trading, you might be an experienced trader, you're not profitable because you're lacking this thing. It's the discipline, it's the psychology part, it's the right mindset that you should have when going into trading. So let us dive into the self-discipline aspect of this. So why self-discipline matters when it comes to trading, why learning about the psychology part of trading helps you. People, you might not realize this, obviously, like even me saying that, you might not realize that this is a really important aspect of trading or becoming a good trader. Why it matters is, like I said, revenge trading, all right? What revenge trading means psychologically is you're not accepting that losing is a part of the game. You're always going to lose. It's a probability game. It's always a probability game when it comes to trading, just like gambling, okay? Gambling and trading are different things, but there's a fine line separating them. Until you understand that, you're going to think they're the same thing. But they're different things. There's just a very fine, thin line separating these two, okay? You have to understand it's a part of the game, all right? You can't take being wrong. If you're impatient, if you have a short-term perspective especially, and you're risking too much, that's the problem. That's where revenge trading comes in, because you get pissed off that you lost a trade and you think that you're never going to lose a trade. You're too your ego is too inflated, okay? You're too egotistic. That point, you're going to revenge trade a lot, okay? All of that plays into revenge trading. Another thing is oversizing. Like I said, risking too much. That's another term for revenge trading. like I said, risking too much. You're trying to get back these losses on basically a gamble. Like I said again, gambling and trading, different things, but they're separating by a very thin line. Okay, they're separated by a very thin line that you can easily come across to and hop into each of them over and over and over again. That's why creating an established, correct system is the only way you can get away from that. Okay, so oversizing and revenge trading, pretty much the same thing. Taking profits early. Now, I had a problem with this. I even posted a reel or a video on this too, like in terms of taking profits early. That was one of my biggest mistakes that cost me millions of dollars, is because I had no confidence in my plan. I was watching my P&L. I was watching how much money I was making or losing too closely. You're always going to look at it. Obviously, I do so right now as well, but you're watching it too closely, you're going to get to the point where now you're going to be like, oh, my trade is, you know, a little bit in green, right? We're in green here. It's halfway to my TP. I'm going to take all of it out. No, brother, no. That's not how you go about it. You can trim. That's one thing that I will always say, is that you can trim these profits. You can take a little bit of profit out, but you still have to hold that TP like it is the law, basically, right? Your stop loss and your TP are the law. You can trim some out. Absolutely. That is a perfect system to go about it. Trim some out at halfway point on the TP, or another valid level where price could maybe reverse, and put your stop loss back to break even, or put your stop loss down a little bit so that you're not risking as much, or you're break even, so you're going to make some money in this trade. It's a break even trade. It's a no risk trade, basically. You made profit, now your stop's to break even. Stuff like that. You always want to make sure that you are understanding the game. But one thing that you should never do is take profits early, because that just goes away from your system. You never want to do that. Never want to go away from your system. You always want to be cautious about it. And even if you're an experienced trader, this is something that you always take with you to the grave, okay? Taking profits early, that's a no-go. You can trim, sure, but don't just go and you see yourself a little bit in green, like, oh, I'm making $100, but you trade to make $1,000, right? Why are you taking away all of your profit at $100? Maybe take a profit at a certain defined level. Maybe that's halfway, and that's like $500, right? Take trims, not all the profit. Take trims and wait for your price to get up there. At the end of the day, you move your stop to break even, you're good. At the end of the day, you're good. Okay, so don't go too much into these things. All right, over trading. This is another one that is just it's defined with greediness and being too short term of a trader, right? Your perspective is too short term because you're overtrading. You're trying to get rich very quickly, which I've said this, and many traders have said this. Many profitable traders have said this. Most of them have gone into that mindset of being like, I want to make money quick because this is what trading is. You think it's like gambling until you actually get into it, and you're like, oh no, you need to know how to trade. And once you know how to trade, once you know the game, you're gonna win, all right? But you need to know how to trade, because you think it's a get rich quick scheme. It's not. You're not going to get rich quick with trading. It's never going to work. You might get lucky for a little bit, but you're not going to get rich with trading that quickly, okay? You're going to get to the point where a couple years from now, you're becoming profitable, steady. You're making 10K a month. What all is that? Whatever. Sure, but don't expect for you in a year or 6 months to become a millionaire from trading. That's just not how it works. Maybe you can take the profits that you made from trading in a year and put it into something else to make you money, and you might be a millionaire with that. Sure, that's exactly how I went with the game. And that might work, but not right now, okay? That's just not going to happen. You have to take it slow. You have to be patient, okay? But overtrading is just being greedy and trying to get rich fast, and you don't have a plan. You don't have a plan of how much money you're going to make that's realistic. You don't have a plan of how you're going to trade. You're just thinking, I want to make money from this. I'm not going to learn. I'm just going to make money, and that's it. You think you're going to make money, but once you actually try to trade, and I think everyone has to go through this at some point, and if you're watching this video, you probably went through this at some point as well. It's the over analyzing everything and kind of once you think that, oh, it's so easy, I'm going to make a lot of money, because a lot of people do get that beginner's luck with trading, and then you're like, oh fuck, I fucked up. This is hard, and now I'm over analyzing everything. That's kind of the rough spot that people get into when they think they are going to make a lot of money trading right off the bat, and then they realize they're not, and then they get into that overanalyzing part because they know they fucked up, and now they gotta get right back on track. That also hinders them from success. So understand that if you haven't been trading yet, or you have and you're listening to this is something that you need to hear. don't go into that over analyzing part right after you've gone from the greediness part. Be calm, be risk appropriate, and be patient, and be disciplined. Like I said, self-discipline. Be disciplined and just wait it out. Do what you have to do. And all these steps are aligned to you. This entire course is literally giving you step-by-step things of what you should know, from the basics, from the technical analysis, from the setup, from the strategies, all the way to the psychological part. And once you have all these parts, you're going to make money trading. You just have to have a successful win rate, successful back testing, all of that, which we'll get into soon. And you'll then realize exactly how much you're going to lose, how much you're going to make. And if your win percentage is over 50% at the end of the day, and your risk to reward ratio is aligned with your win percentage, and you're taking a certain amount of trades that you know you're going to take, all of that is probability. And then you're going to make money. But you're not going to make a lot of money, because you have to understand you're going to lose money as well, right? It's just a win-win situation, but it's also a win-loss situation. You lose money, you make more money, okay? Pretty simple. Understand that, and it'll be okay. Don't get too nervous. A lot of people get nervous when they trade, and that's something that I think is evident as a human. Your human emotions, human nature to get nervous no matter what. And it took me 5 years to get to that rut where I'm not nervous. But within those 5 years, I was doing dumb shit for the first year. And then after that, because I didn't have a mentor, right? I was doing dumb shit for the first year. And after that, I got into the realization that I'm not going to be emotional like that. I might be emotional, but I'm not going to act on my emotion. That's like the worst thing that you can do. I know a lot of you are religious as well. You have these thoughts in your head. You have these either greedy thoughts, or you have jealous thoughts, lustful thoughts, whatever it is. You have that because that's a normal thing. It's human nature. The devil puts it on us, right? But at the end of the day, you don't act on it. Exactly like trading. You can be emotional. You can see your stop loss about to get hit. You can see your take profit about to get hit too, and you're emotional. But don't act on it. Don't take profits too early, okay? Don't oversize. Don't revenge trade because you lost a trade. Don't act on your emotion. You can be emotional, but don't act on it, okay? Now, the other one is moving stops due to a gut feeling. It's like, oh, I know this is going to hit my stop loss, right? I know it's going to hit my stop loss right now, but I'm going to move it a little bit because I got a gut feeling that it's just going to stop at my stop loss, and it's not going to go below that when I move my stop loss. It's just going to continue up. It's going to reverse. That's just going to make you lose way more money. You have a set plan. You have a set system, all right? You can get yourself a plan. I can make you a plan, whatever it is. It doesn't matter what plan it is as long as it actually works and it's back-tested to work. You have a set system. You know it's going to work majority of the time. Don't change it. Don't change just because you got a gut feeling. I've got a gut feeling so many times in my life, and guess how it ended? Very, very badly, okay? So don't change your stops. Don't do anything to a gut feeling, to just how you feel like it's going to work. Trust me, it's not majority of the time. And I hate when people get lucky. That's the worst thing about it. People get lucky when they do things like these. They do all this. They revenge trade, they oversize, they take profits too early, they overtrade, they move stops because they feel like they got it, or they move their take profit a little bit down or a little bit more up, stuff like that. Just because you have a gut feeling, it's never gonna work out, man. And I hate when people get lucky with that, because it kind of incentivizes in their head that, oh, maybe they're onto something, and then they keep losing more and more because they keep that thought in their head, like, oh, I did it a couple times. No, you got lucky a couple times, my brother. You're not going to get lucky all the time, all right? So in life, it's always good to be safe. Better safe than sorry, all right? And in terms of this, I know you got to take some risk, but you're taking a risk is just getting into trading. And trading, you're learning how to trade. That's the risk you're taking. You shouldn't take a risk in terms of doing things the wrong way. That's not right. That's not a correct risk. That's just being stupid, okay? So these are the reasons why self-discipline and patience and having a good mindset matters, okay? Because if you don't, you're going to do all these things across the board. I guarantee you're not even going to miss one, all right? So just keep that in mind as we move forward with this. Now, remember, like I said, we are human. It's in our human nature to make these mistakes, all right? We fail, but we always come back up, and we have these emotions, all right? But we shouldn't act on it, okay? So one of the things is identify, not remove. Understand what we are feeling, what you're feeling in real time, and adjust your rules to accommodate to them, okay? You always want to make sure you know how you're feeling. You can't don't let it just hinder. Don't let it just go away. Don't try to forget about it. All right? Don't try to forget about your feelings because they're there. And if you keep forgetting about them, they're just going to keep coming and crawling back into your mind until it takes over. Okay? So understand what you're feeling. Talk about it, Understand this feeling you have. Fear, if you're afraid, usually means you're risking too much money or you're unconfident in yourself. And that's the biggest things is the unconfidence versus the overconfidence. I think majority of my students at least are unconfident in themselves. They're afraid of getting into trades. That's why they know their system works, let's say 70% of the time, their strategy works 70% of the time, but they're still afraid to get into it because they feel like they don't know what they're doing. They don't think their system and plan actually works, even though it's shown to work. The number doesn't lie, Mason. The number doesn't lie, okay? So fear usually means that, or you're risking too much money, and you would know that because you have a set system and plan. That means you know exactly how much money you're willing to risk. Where's a safe amount? Okay, how much money do you have in your account? 10K. How much should you not risk more than that? Don't risk more than, let's say, 1 to 2% of your account per trade. You got to understand these things, okay? You're risking 10K from trading, but if your plan is all right, if your plan is set, if you have a certain win percentage, you're going to win, all right? You're going to win the money back, but you might lose some trades in or during that, okay? So understand that if you're afraid, usually it means these two things. You're risking too much money and you need to cap it down a little bit, or you're just unconfident in your plan, yourself, whatever it is. Greed usually means you have too much of a short-term perspective. I've seen countless of people quit their job, actually quit their job because they think that they're going to get rich off trading very quickly. Now, I've seen two different roads of this, two different paths. I've seen one path where they immediately quit their job after they find out about trading, and then they're just into trading. I'm going to learn to trade a week, and then a month I'm going to make millions of dollars. I'm going to make back what I was making previously in my previous job. The other path of greed is they think they're going to make all this money in such a short-term time span, and they learn how to trade and they actually get good at trading while still having their job, right? And then as soon as they're able to understand how to trade and they're able to have a system in place and they know they're going to make money trading, they quit their job, right? Both of these things. The second one might seem good in a sense. It might seem better than the first one, but they're both going to set you up for failure. You don't quit your job. Trading isn't something that you just do to quit your job, all right? At first, you have to start as a side income, right? You're making a little bit of money on and on and on and on until you're actually able to replace your career with the money you're making. And I wouldn't even stop at that. I would go more than that until you're able to make twice what you make in your job. Then I would be like, okay, I can quit. Because at the end of the day, what are you doing? If you have a family, if you have kids, and you're thinking of quitting your job when you can make one side income and another one. What if you're making the same amount of money you're making trading with the job that you have? That's twice the income you have already. Work with it. If you're already able to do it, why not? Why stop? There's no reason to stop. You're making all this money to support your family and yourself. Don't be stupid. You're a man, or you're a human. You're made to work, right? Don't be an idiot. Keep doing that. Don't just quit your job just because you made the same amount of money maybe that you're making with trading that you made in your previous job. Why not even go further than that? Why not go and take a step up, say, okay, until I make the same amount of money I would make if I'm trading and having a job, I'm going to keep my job and trading, okay? So when I make twice that, I'm going to quit my job and I'm just going to get into trading because I'm profitable enough, to consistently make twice what I make with trading and my actual job, and then quit, put some of that money into investing as well. That's the important thing. When you want financial freedom, when you talk about financial freedom, people think trading. That's not that. It's not just trading. You have to learn how to use the money you get from trading to other avenues of stuff. Maybe start a business, maybe invest, things like that. That's what accrues money exponentially, so you actually have freedom, okay? Get a house, buy a house, rent it, sell it, work on it or sell it, stuff like that. Real estate helps a lot in terms of financial freedom. So many things help a lot in terms of financial freedom. You got to understand that before you put your money, or you got to understand that before you actually take the course of quitting your real job. You need that until you can grind enough to actually make twice what you make with trading and your actual job, all right? Revenge, that usually means you're gambling, okay? If you have this emotion of revenge, you're pissed off, you're mad that you keep losing trades, and you keep losing trades on and on and on and on and on, you're gambling, brother. You're gambling. You can't, like, that's an okay emotion to have. You're human. You might have that. You might be angry. You might be, disappointed in yourself because, you're in your trade because you didn't hit your trade. It didn't hit your trade. It hit your stop loss consistently. There's a reason why it's hitting consistently because now you're just gambling. Now you're throwing away your system and saying, fuck it. It doesn't work anymore. And then you're just putting it all into your emotions. That's what true gambling is. That's the fine line from the trading and gambling. It's the emotion part, okay? It's a very thin line, and that's the emotion part. Once you let your emotions take over, you're in the gambling side. Once you let your logical side take over, you're in the trading side, okay? So fear and greed and revenge are usually the most common ones. I would say fear is probably the most common, and then greed, second common, and then revenge or getting mad is the third most common, okay? Going on to journaling. Before you press buy, before you're in the trade, whatever it is, okay, when it hits the P, all of that kind of stuff, before you even press that button to get into that trade and set up your stop loss and your take profit, journal. All right, journal what you're feeling in that moment. Write down what you're feeling in that moment, okay? Write down before you press buy your plan and how you're feeling. Then once you actually write all that down, press buy, Write while you're in the trade, what you're feeling, your emotions, and how you're feeling. Write exactly your game plan in terms of how you're going to go with this and how you're not going to let your emotions take over, how you're going to actually see this trade out. Write down when it hits TP, how you feel. Write down when it hits stop loss, how you're feeling in that moment. Write all that down because that'll help you. People always say write stuff down because it helps them. Write stuff down because it jots in their head to remember these things. Write it down. It's not gonna kill you. You're not doing anything. You're probably, when you're in a trade, probably on your phone, just doing shit, while you're in the trade, when you could have time to just make yourself a better trader and actually write things down. Do that. Journal. That's one of the most important things when it comes to trading, and psychologically making your mind better and stronger, making you have a better mindset when it comes to trading. That's writing things down. So get a notebook, whatever, journal, all right? I would not do it online. I would not type online because that creates a lot of attention onto your phone, that you don't want, because you can always just, even if you don't have ADHD, your mind can just wander, and then you can go on your phone and do other stuff. So I never recommend journaling or writing on your phone. Just get a notebook and then, write your emotions down before you press buy, while you're in the trade, when it hits TP, when it hits stop loss, how you're feeling, how you're going to go about that day in the trade. If it hits TP, how you're going to go about your day. If it hits stop loss, how you're going to go about your day. Write that, and then it'll signify it in your head to do these things, okay? Longer term mindset. People have a very short term perspective, especially when they want to make a lot of money really quickly, especially when they want to quit their job really quickly. You want to look at it as my next 100 trades, my next 200 trades, my next 300 trades, as many trades as you can possibly get to next to it, my next 1,000 trades. You're looking at a long term in the future, especially when you try to find your win percentage or your win rate, how good of you are a trader with this strategy, with the setup. You look at your next 100, next 200, next 1,000 trades. That's what you're finding, okay? Your trades, your past trades, your next trade, they don't really matter. You're looking at the future. Let's say you took 100 trades past and you lost all the money. They don't matter, right? You already lost that money. What's it going to do to you looking back? You know the mistakes you've made. You know you failed in these mistakes. You know what you have to do right. So stick with it and do that for your next 100 trades, your next 500 trades. Stick with that and do that. That's what really matters. Your past does not matter. Your next trade does not matter. Your next 100 trades matter, okay? You want to have a detachment from money. And that's a hard thing to do when you're looking at a P&L and looking at the money go up and down. I'm not going to lie to you. But it's the only thing that works. All right, sad to say it's the only thing that works. Remove the P&L from your screen. You can do that. Whatever brokerage you have or whatever trading platform you have, you can do that. So instead, use ticks or points or pips if necessary, whatever kind of thing. Use the risk to reward ratio when you're making your stop loss to your take profit when necessary. All of that. Trade the charts. Look at the charts. Trade the real economic data. Okay, trade all of that. Don't trade from the P&L. Okay, You can put how much money you're going to put in the trade. I always do, because I have to know how much money am I going to put into this trade so my stop loss and my take profit actually line up with how much I'm losing and how much I'm making. That's evident. But don't look at the trade when you're actually don't look at the money when you're actually trading. You have to know how much money you're putting in a trade, obviously. But don't look at it when you're actually in the charts and trading. Set your stop loss, set your take profit. This is how much money you're going to lose. This is how much money you're going to make. Whichever one hits, you're okay with it. All right, that's it. That's it. And it's harder said than done. Yes, it is harder said than done. But sadly, you got to go with it. That's just how it works. All right, this is the point when you're having self-discipline. This is the point when journaling is crucial, especially when you're in the trade. Write down how you're feeling. Understand it. Accept it. Acknowledge your feelings. Acknowledge your emotions. Write it down, and write down how you're not gonna go with your emotions, or you're not going to let your emotions take over. Write all that down, and it'll signify in your head to stick with your plan. Okay, stick with your plan. Writing it down and journaling will help you signify that and keep it solid and keep you on your feet. All right, keep you on the good side. Go into each trading day trying to repeat the process and not make money. Right, you are going to win. You are going to be happy, and you're going to feel happy when you stick to your rules, not when you're making money, okay? If you stick to your rules, you are good. Even if you lose, you stuck to your rules, you are good. You want to go into each trading day thinking like that, all right? Repeating the process. Go in the morning, wake up in the morning, do whatever you got to do to wake up, take a shower, whatever it is you do, eat, drink coffee, then sit down, look at the charts. Find your setup, find your strategy, find your setup within your strategy in the charts right now in the day. If you don't have anything, write it down. But make your plan. Make your pre-market plan. Make your pre-trading plan, whatever it is, right? This is my pre-market plan. I see da-da-da-da. I see da-da-da-da-da-da. I see that I can trade this. I see this day I can't trade because there's too much data or news. I don't have any setups right now. Da-da-da-da-da. This is what I'm going to do. Once you have that, you're aligned perfectly with your plan. Do it with your plan. Your plan is basically your marriage, kind of. You are married to your plan at the end of the day. You can't waver from your plan. It's against the law. Think of it like that. It's against the rules to waver off of your plan. Don't skip it, all right? Stick with your plan. If you have a trading plan, a pre-market plan, a pre-trading plan where you can't trade that day because you see no setup, stick with that. Get out of the charts. Leave. Set alerts once it hits. Make a pre-market plan that's saying, okay, I see no setup right now, but if it does get down to this level, I'm going to set an alert and I'm going to get back in the trade because this is my setup in this level, in this price, around this price. All stuff like that. Do that. Go into each trading day, repeating that process over and over, and you'll be much better off, and you'll feel happy. I'm very happy when I stick to my rules versus when I make money. Don't get me wrong. I'm happy when I make money too. I'm human. I'm not a robot. I'm not an emotionless robot. When I make money, I'm happy. When I lose the money, sometimes I get a little sad, but I don't act from that. I don't act with my emotions, okay? I let my emotions come in, I acknowledge them, and then they're out of the way, all right? They're out of the way. I lost money, whatever. I'll make money back again. It's a probability game. It's always a probability game. It's like gambling. Gambling is a probability game, but you can make a lot more money trading than you can gambling, because when you trade, there's actually a set system involved to trade, okay? And make money while trading. Confidence is one of the biggest aspects, like I said previously in this video or in this part, that hinders people from becoming profitable. You're not confident, you're not going to do well, okay? You have to be confident in yourself in any aspect of life, really. I mean, you think about it. You think you can open up a business? You think you can get a pay raise if you're not confident in yourself? Come on. So to be able to master market psychology, you need to have full confidence that you and your setup will work a certain amount or a certain percentage of time. All right? Your setup will work a certain percentage of time. That is confidence based on your pre-history of you backtesting, of you planning out, of you trying to figure out, analyzing how well your setup works. The numbers don't lie. The numbers don't lie. If your setup works for a certain amount of period of time for 100 trades that you make, 70% of the time, more than likely your trade is going to work. Your setup is going to work 70% of the time, so forth and so forth. Depending on market changes, you align yourself with the market change. All of that, at the end of the day, majority of the time, it's going to be around 70%. Okay? This is why we need to have screen time until we can read setups like the back of our hands. Okay? I can look at every setup I have and I know exactly where it's going to come. I know exactly where it's going to be. I know a majority of the time, let's say 80% of the time, it's going to work out. Market changes. There's a dynamic market change, recession, whatever it is. I change my ways. I tweak my strategy a little bit. I tweak my setup a little bit. I don't care. But majority of the time, in real market, it's going to work 80% of the time. All right? Because I have enough screen time in my name to say that I can read setups like the back of my hand. I can read my setups like the back of my hand, okay? Because it's the law. It's the rule for me. I never changed for my setups, right? After a year of me learning how to trade, I never did. I always stuck with my setups. No matter how hard it was, I always stuck with it because I know I had enough screen time. I had enough past history to know that my setup works 80% of the time or more, okay? That's just it, all right? You need to have enough screen time. You need to have enough back end in the dirt, getting it to actually figure out how well your setup is. And my setup works a majority of the time, a little bit about 80% of the time, but it always matters. It always holds up, right? To who you are. You know, my setup can work for me 80% of the time. But it depends. It always depends on the person. Okay, so if you can look at my setup and you can work on my setup, see how well it works for you. It's gonna work around 80% of the time. It might be a little bit less, it might be a little bit more, but that's always dependent on who you are as a person. But if you are as strict as me about how I do my things and how I work, and at the end of the day, this is my setup when it's fully tweaked. Right now, at this moment, it's gonna work about 80% of the time. And if you actually stick with it and do everything that it's said to do, don't hinder from it, don't tweak it at all, it's going to work around that. Now, I tweak my strategy, my setups every time, all right? Because at the end of the day, the market changes all the time. You can't look at it as a holy grail. Your setup, your strategy isn't a holy grail. It's how you view the market. It's how you can adapt to the market. Adapting to the market is the holy grail. You have to understand how the market works. That's why also having enough screen time reading your setups, you also have enough screen time reading the market. So you know how the market works. Look at the past history of the market. Look 3 years ago, 2 years ago, 1 year ago, look till now. See how maybe the future is going to roll out. And then 100 trades come in, you know, let's say a year goes by and you're still in the trading and you see, okay, this is how this year gone by, you know, I can kind of relate it to this year, you know, kind of relate it to this year. I can kind of see how the similarities between this trading time, this market versus the past market like a year ago during this month, whatever it is, whatever. You have enough screen time, you'll be able to read not only your setups at the back of your hand, but the market like the back of your hand, okay? So confidence is key. Now these are my rules. And you can stick with these rules or you can tweak them a little bit. You can make new whatever rules you want to do, make sure they work, okay? Everything about it, you have to make sure it works. Everything in this video is my setup. Everything. The basics of what I taught you in the first part of the video, my setup. The technical analysis part that I taught you in the first part of the video has to do with my setup. The setups I have, my setup. The strategy I have in accordance to my setup. The psychological part of this in accordance to my setup, like my rules. It's my setup. So my rules are this. I do 3 swing trades a week max. No more than that. I have never done that. I can confidently, you can put me into a polygraph machine in terms of when it comes to me swing trading. Never done that. 3 swing trades a week max. 2 losing trades a week max. If I lose 2 trades in a week, my swing trades, why do I want to take another trade? Why? This doesn't make any sense in the first point, but nevertheless, throw that away. I've done my research. I've done my due diligence. These are my rules that I've had for years on out, and I've done my due diligence to see exactly how well this makes me as a trader, all right? How well this helps me and benefits me as a trader. And 2 losing trades a week benefits me a lot because two losing trades a week, I'm in a red week, okay, at the end of the day. I know that. And why would I want to make another losing trade? If I do, even if I make another winning trade, I'm not going to get back my red week. At the end of the day, it doesn't matter. So I'll wait for next week. I'll get my head a little bit right, you know. I'll take a little bit of a rest. I'll still look at the market every day, but I'll take a little bit of a rest, and I won't get into any trades until next week when my mind is good, you know, I'm solid. Because once you lose 2 swing trades a week, especially with the capital I have, I'm talking about 50 grand or more, it does hit a little bit, right? So I have to take a rest. I have to get into the groove again. So that's why I know that 2 losing trades a week max is okay for me, all right? I'm not terribly sad. I'm not mad. But if I did one more trade and I lost that one, I'd be absolutely hysterical, okay? So those are my 2 big rules. 3 swing trades a week max. And if I have one big win, I might take another one, right? But I only take one more trade that week only if it's a best outcome trade. Okay, if it's in the best outcome, it goes with my checklist, every single part of it, and it has the best outcome. I know the probability of this hitting is like 90% or more at the end of the day. I'll take it, but at the end of the day, I usually don't, because after a big win, why do I have to take another one? If I make $100,000, why do I have to take another one? It doesn't make any sense, right? So I stick with it like that. All right, 3 swing trades a week max. If I win 3, I lose 1 swing trade and I win 2, stuff like that. I win 3 small swing trades, things like that. All right, that's the only when I take 3 swing trades a week, is if I lose 1 and I win 2, or I win 3 small ones. Okay, but yeah, 2 losing trades a week max. Nothing more than that. Never gonna hinder from that. That's stuck in solid. Okay, but after a big win, I only take 1 more trade if it's the best possible outcome for that trade. Okay, I never size up after a loss. My guy, I've seen so many people size up after losses. It's incredible. It doesn't make any sense. That's again where the revenge trading and the over trading comes in. I don't know. I don't know how it aligns in their head, because I've never had this problem. I just think it's kind of common sense, to be honest with you, but people do this for some reason. I don't know why, but I never size up after a loss. There's no reason to size up after a loss. You lost money, right? Maybe if you win a trade, you might want to size up the next week or something like that, but why would you size up after a loss? It doesn't make any sense. You're losing. You already lost the amount of money you should lose, and now you're sizing up to maybe lose even more money. That completely goes away from your plan. Definitely set that up as your rule. That is a rule you should have. I know it's common sense, but people sometimes don't have it. I've had many students, when I talk to them first on getting them onboarded with me, say, oh, my biggest problem was after I lose a trade, I tended to put a little bit more money into that trade because I thought it was really going to hit the next time. You think things are going to happen, the market's going to fuck you in the ass, and it's not. Okay, so understand that. If I have a losing week, then I size down until my next green week. That is also a holy grail. If I have a losing week, which again is 2 losing trades a week, or I just trade 1 time a week, I guess, and I lose that trade, whatever it is, because I don't see another setup. If I have a losing week, then I size down until my next green week. So if I have 2 trades that I lost that week, next week I'm sizing down. I want to build my confidence up, right? Because it doesn't matter how you say, you can be confident, but if you have a losing week, your confidence goes a little bit down, because you're second guessing yourself and the market at the end of the day. So I always size down just to keep it safe and just to keep my confidence up a little bit, because even if I have another losing week, I size down, so I'm not mad about that at all. But I size down a little bit until if I get next week, I get a green week. I might have not made a lot of money that week because I sized down, sure, but I'm more confident in myself, and then I size back up next week and I can get right back in the game. Okay, so all these rules align to how I am as a trader, and it makes me very, very good at what I do. Okay, so I stick with these like the holy grail. My rules, my setups, they're the holy grail. All right, but me actually trading and making money, that's not a holy grail. Your strategy isn't a holy grail. It's your rules and your risk align with that strategy. That is the holy grail. So 3 swing trades a week max, 2 losing trades a week max. After a big win, I'll take 1 more trade if it's the best outcome for a trade. I never size up after a loss. It should be common sense, I know. But if I have a losing week, then I size down until my next green week, and then I pick it back up just to build my confidence. Getting out early, that's one of the things we were talking about, and this was a problem I had. It was, all right. I set a TP on next reversal level and a stop loss on next validation level, and I walk away now. I did not used to do that. I did not have that plan the first year. I used to look at it like, okay, I have my stop loss and my take profit, but what I'm looking at is that it's in the green, right? It's not right at that take profit. It might be a little bit less, it might be halfway, but I wanted to take full profit, and I did sometimes. What did that do? Well, because I'm still having that stop loss set, right? That stop loss is still set. I have the original stop loss and a modified TP. What happens when you do that? Because your strategy, your plan is aligned with the TP and the stop loss that you're putting in. So what happens when you have a modified TP but a set and original stop loss? You lose more money than you're going to make, right? That's the whole point of it. Your set TP should be at a set risk to reward ratio. Let's say it's a 1 to 2. If you move from that, you're going away from your risk to reward ratio based on your win percentage. You never want to do that, because if you hit your stop loss, you're going to lose more money than you're going to make with your TP because you modified it. Does that make any sense to you? It should make a lot of sense, because you have to have an original TP set and an original stop loss set. If you have one modified TP or stop loss, you're going to lose more money because it's not aligned with your plan that you made in the beginning. All this comes in that you have an original plan, an original system set up, with your strategy aligned. If your risk is changed, it's going to hinder from your setup and your plan, your original plan, and that could cause you to lose more money overall, right? It might not be extremely imminent, right? But it's overall in the time being, since your probability is always set, you're gonna win 70% of your trades, whatever it is. Since your probability is always set, it's gonna over the long cause you to lose, over the long term, cause you to lose more money. So I hope that made sense to you. So don't have a modified TP and a modified stop loss. You can trim levels. Make sure it's in your plan though. Make sure your setup has an indication saying I trim my levels, okay? And I move my stop loss when I trim my levels. Don't just trim and then have a set stop loss. Again, that doesn't work. So be cautious about it. So if you have a modified TP or a modified stop loss, over the long term, it's going to cause you to lose more money, okay? Everything in between is noise. Once you're in a play, all right, and let's say you have a trim setup or a limit setup to trim or whatever it is, it would either hit your stop loss or your trim level or your TP. Nothing else matters, okay? It's right now, bro. You're in the future. You can do this. You don't have to do anything else unless you click buy. You don't do anything else after that, right? You have a set stop loss, a set TP that it will hit. It will hit it. It will trigger it. 99% of the time. Sometimes it might do a little bit of a fuckery, but sorry for my language, but 99% of the time it will trigger it, okay? So you don't have to do anything. You literally, getting out early is just retarded, all right? That's what I think, I've done it before, and I can safely say it's just stupid. So set your TP on next reversal level or whatever invalidation level you have, set a stop loss on next invalidation level, and walk away. You're in the future, you have the systems and the platforms that are very technological. They can set your triggerings for your stop loss and your TP, and you just walk away. Nothing else matters, all right? Everything in between is just noise. You don't have to keep looking at it, especially since you're swing trading. So it might be like a day or whatever, and you're just fucking looking at it like this, like thinking, oh, when is it going to come? When is it going to go? I've done it before. It sucks. And that's the whole point. Trading is not supposed to suck like that, okay? So try this for a month. That's all I'm asking you. Just try it for a month, man. Stop getting out early, just get your orders in place for your TP and your stop loss. And if it happens, it happens. If it doesn't, it doesn't. At the end of the day, try it for a month. See how much better you are. Walk away. Okay, walk away. Set alerts for your TP and your stop loss or your trim level, whatever it is. Walk away. There's really no point in doing anything else. All right? That's it. Now, I have a checklist here involved, and I would literally print this out or take a screenshot or whatever it is, or just do your own on this and look at it, right? This is a checklist that you all should have. It doesn't matter what kind of rule you have in place. It doesn't have to be these rules, but it should be a checklist that you have that you can check it out, okay? Remember, only trade key levels. That's the first thing, most important one. Don't go away from your key levels, okay? Only trade your key levels. Is in a supply and demand zone. Yes, check that off, right? Pre-market research, one of the most crucial, right? You want to find your key levels in the first place. You want to find the volume profile. You want to see how much volume is going in today in the market. All of that is very important, okay? You want to find, you do your pre-market research, because then that'll help you for the market open, or more you're actually trading in the market. So remember, only trade key levels and do your pre-market research to find the key levels and the volume profile and all of that, okay? Write out your trading plan. Because once you've done your pre-market research, once you've found your key levels, now you can make your trading plan. You surely can make your trading plan. You want to see your entries. You want to see where does the price have to pull back to or pop back up, whatever it is. Where does price have to reject or bounce or sweep? Where does price have to break a zone and then retest back down? Where? Write all of that. Then write your entries. Write where your TP is going to be, where your stop loss is going to be, deciding on what happens in the trade, obviously, in the market. But write all that down to the T. Everything. Don't miss one single thing out. Write all of it. All of it. Extensive as you can, okay? Make sure, once that's good, check it out. Make sure it collides with risk management plan, okay? So make sure you're able to have a set entry in accordance to your stop loss to take profit, so it collides with your risk management. Make sure it's a well enough risk to reward. That's basically what it says. That's the most important part, is make sure that it's aligned to your risk to reward. Make sure the ratio from risk to reward is aligned with your plan, with your risk management plan, and that's again based on how well is your setup. What percentage of the time does your setup hit and win? That's it, okay? If that's good, if it is aligned perfectly, check that out. All right. Start small. Size up when conditions get better. And I'm sorry, but as a beginner trader, you can't afford to lose, okay? Especially if your account isn't that big. So what's the point in you starting size up, right? Start small. Be safe with it, all right? Better safe than sorry. Better safe than being broke. So start small, size up when conditions get better. Once you're more confident in yourself, when you're starting small, you're starting to build that capital up and conditions get better, maybe the market's in an iffy time, whatever it is, always better to start small, and then when conditions get better, when you're more confident in yourself, you're making consistent money, then you can size up a little bit, all right, when conditions get a lot better. I don't mean sizing up all the way like 100%, but size up a little bit by little bit, your money will go up, okay? Check the economic calendar. Man, oh man, oh man, especially if you haven't traded yet, you're just learning how to trade. Things can happen. Data can come out and you won't know. If FOMC comes out and you don't know, like I said, 10 a.m., you're absolutely you're fucked. At the end of the day, probability is you're gonna get screwed over. Okay, so check economic calendar. Check, is Trump speaking? Because right now you're in a time where that's one of the most important things you have to check. Is Trump gonna speak? Check Truth Social, all of that. Okay, economic calendar. Check what's going on in the world politically. Do all of that. I would even add this as your pre-market research too. So all of that, check. Is there going to be data involved at a certain time and will I trade during data? Will I go before it? I always recommend you not, but if you're swing trading, it's a little hard to do that. But if you're day trading, I always recommend going away from that. But as a swing trader, it's okay. I would maybe classify you doing swing trading after the economic data, things like that. But at the end of the day, it holds on to FOMC. You're a swing trader. FOMC will happen. News will happen, data will happen, earnings will happen, whatever that happens, it happens. You're swing trading, you're looking at the overall market in a longer term perspective. So at the end of the day, it's okay. But I would always maybe look to hinder it. Maybe FOMC usually hits in the morning from the market open, like at 10 a.m. Maybe hinder from that, right? If it hits at 2 p.m., maybe hinder from that. Whatever it is, you can go at it with your own risk. I'm not going to say exactly if you should trade right before, if you should take out the day off to swing trade with FOMC, whatever it is. I'm not going to tell you to do that because people have their own different type of risk involved, but I would definitely say check it out, all right? Look at it. See what's going on in the day for the market and politically in the government, in the world, all of that. Especially if you're trading gold like I am, silver, all of that. You definitely want to see the political tensions in the market because gold can drive up or drive down depending on what happens in the world. Wait on confirmation, all right? You have your plan. You wrote out your trading plan. You should have wrote out your confirmation. All right, what's going to be your confirmation or your best confirmation to have the plan? Let's say you're looking for a reject. Wait for your confirmation. Has it not broken close out of that zone for a reject in your supply for shorts, and then has it came down and closed, or came down and closed below that zone, or did it came down below that zone and cross a certain validation level to the point where now you can enter the trade? All of that's confirmation. You look at the real-time market data. Are you looking at shares? Are you looking at the volume profile? Are you looking at footprint charts? Are you looking at order flow? Whatever you're looking at for confirmation, make sure you're waiting on that confirmation, okay? 3 trades per week max. All right, that's my checklist for the week. 3 trades per week max. I'm not going to hit for that. Once I do 1 trade, I check 1 trade off. I have 2 more trades to do. If I win 1 big trade, I have my choice to make. Do I get another trade if it's a big win, but it has to be really, really good? Or do I just let it go, Maybe I'll be like, okay, it has to be a really good trade. This is the trade that I'm looking at. If this comes in, which it's unlikely to do, I'll get into the trade. I'll get into that trade, I promise. But if it doesn't, I'm okay with it because I have a big win. Those kind of things. And even if you don't, right, don't look at it. Don't look at trades thinking they're actual trades. Don't look at the market trying to find a trade, because then you're going to find many trades. If you look at the market trying to find a trade, you're going to find many trades, and that's not a good thing. So look at the market trying not to find many trades. Look at the market based on your checklist, based on your rules, based on your setup. You're not going to find that many, but that's good because those are the trades that are giving the most highest probability to make money, right? Next checklist is 2 losses per week. If I lose 1 trade, check that out. I have 1 more trade to do. All right. If I lose that, if I don't find any trades, perfect. I have 1 trade that I lost a week. That's okay. But if I find another trade that's a really good setup and I lose that trade, that's maxed out. I can't trade anymore. No matter if I find a really good setup after that, I don't care. I'm not trading it. That's the whole point of having a checklist and having your rules. You can't hinder, you can't move away from your rules. You can't let it go. These are your rules. This is what works for you. Don't let it go. Okay. That's it. Now we have the analytical tracking of this. All right. Analytical tracking just means recording your actual trade setups and all of that, not psychologically, just analytical, using your logic behind it. Record your entry, okay? Record your intended take profit and your stop loss. Where are you going to take profit after you enter this level? Where are you going to put your stop loss? How much money are you going to get lose from that, right? How much money are you going to make from that? Record your exits. When you're in the trade, record your exits. When you exit, I exited right here. This is my trade, okay? Record your setup. Record what your setup is at the end of the day. Record what setup are you using for this trade. All of that. You have to be very in-depth, very in-depth, very in-depth of everything you put into your journaling when you're writing and recording things, because you want to look back at it and you want to know exactly what you did. If you make it a vague, and I've done it before, I'm telling you, everything I'm telling you is I've done from experience and how it doesn't work or how it works. If you make it very vague, you're going to forget what actual trade you did, right? So record the time, right? Record the price it was at. Record everything in depth, because if it's vague, you might forget about it and you might not understand what you wrote, okay? But if it's very in depth, if it's very extensive, you're going to remember all of it, okay? So record your setup. Record your entry trigger. Entry trigger, very important. Record what triggered your entry, all right? Record what confirmation you did. Did it close below that zone? Did it move below a certain validation level where it's a clear shot down? Record all of that. Record what triggered your entry, okay? What triggered you to hit that buy button? You know, was it a volume spike up? Stuff like that. Record that, all of it in depth. Record your risk to reward ratio. What was the stop loss and take profit in terms of risk to reward? You know, was it 1 to 2? Was it 1 to 3? Was it a 1 to 1? And see, okay, if it's 1 to 1, but that's not well within my win percentage, my win rate, I'm not going to take it. Stuff like that. Record all that in depth, and then you will become a much better trader over a course of a month, 2 months. You'll have that in you as a habit, and you'll keep on doing it until you become profitable, and even after that. Psychological tracking. The analytical part of it was very simple. It's like I said, analytical part, the logic part of it, defining the strategy, understanding the setup, that's so simple. You just have to do it. You just have to learn and you have to do it. You have to journal, you have to write it down. It's so simple. The hard part is the psychological part of it. And that is true because we're humans. Our worst aspect of it is being mentally fit to do our thing, mentally fit to do what we have to do. That is the hardest part of it. But once you actually grasp the idea that you can be emotional, right? It's okay to be emotional. I don't want you to be an emotionless robot while you're trading. It's okay to be emotional, but don't act from your emotion, all right? Journaling is the most important part of the psychological aspect, or the psychological tracking, like I said here. Thought process. You want to journal your thought process going into before the trade. You know, how do you feel before the trade? Are you sick before the trade? Did something happen before the trade? You know, did your girlfriend break up with you, right? Whatever happened, are you mad? Did a family member die, pass away? All of that. Record that thought process before the trade at all. If you're too emotional before the trade, don't trade that day. Take a rest break, right? Leave it. That's the whole point of it. You have to understand that your emotions, if it's too big, it's going to cause you to make a lot of problems. That's what I say all the time. If I have something really heavy going on, I don't trade. I don't care if I see a really good setup. I'm put that thought process before a trade, and I'm like I'm journaling down. I'm saying like, oh, something shitty happened for me yesterday or this morning just now. I don't think I'm gonna be up for fit to trade because I think I might get too emotional. I might overtrade. Record that, and then walk away. Right? If it's too emotional, if it breaks if you think it can break your will to not act from your emotions, don't trade that day. Okay. That other one is thought process during a trade too. So while you're in that trade, you might, especially when you're a newbie and you're starting out, your emotions going to go on a roller coaster. Write all that down. That helps you so much to not act on it. Okay, write it down. Are you feeling like anxious because it's near your stop loss? Is it really close to your TP and you're like happy as shit? You keep going. Write it down because then it will help you a lot in not acting on your emotions. And like I said, as it approaches your stop loss, how do you feel? As it approaches your take profit, how do you feel? Do you feel happy? Do you feel sad? I don't know. You know, whatever you feel like, it doesn't matter. Just tell me how you feel. Write it down. Journal it down. How do you feel during this moment? And I know you might think it's such a little like a sissy thing to do. It's such a girl thing to do. It helps, bro. It's not a girly thing to do. It helps you stop you from doing dumb shit. Okay, when you're trading. And I only say that because I've done this before, with and without journaling. I've won more trades and I've been more consistent with journaling. So there's certainly, and I've taken thousands of trades. Certainly there's a correlation to that, right? So that's what I'm trying to say. If you want to talk to millionaire traders, all of them have journals. Talk to an unprofitable trader. None of them journaled, probably. So what are you gonna do? You gonna be a sissy and journal? Go do it. At the end of the day, if that's gonna make you more money, if that's gonna make you more consistent, do it. Next one is after a trade. How do you feel after a trade? Are you good? You know, or if you hit your stop loss and you lost money, how do you feel with that, right? Eventually, at a certain point, when you're journaling all the time and it becomes a habit, and you're trading and you understand that, okay, I lose trades, but I win more trades and I win more money while I'm with those trades that I won. Eventually, you're gonna think to yourself, oh, you're gonna journal and be like, at the beginning, when you lose a trade, you're probably going to be very sad. You're going to be like, oh, I feel sad. I feel nervous because I don't know if I can do this. Eventually, at a certain point, once you start being confident in your setup and you start realizing that, oh, my win percentage actually is right. It makes sense. Then you're going to be like, okay, you lost a trade. How do you feel? You're going to write in your journal, not that bad. Not that bad. I lost a trade. I get that, but I'll come up. I'll come up. Another trade for this week. Let's see if we get it. Stuff like that. And more than likely, you're going to get it. You're going to hit. You're going to have a green week. Even though you lost one trade, you're going to have a green week. Just stick with that, okay? Journaling, the most important aspect of it all right? Now, why we have these things, right? Why I'm telling you all of this? Because I want you to understand what psychological factors are impacting your trading decision. What emotions are you most headed on, right? Do you get more angry? Do you get more nervous? Are you more scared? Are you more unconfident in yourself as a person overall? All that comes with before trading, just your life in general. Doing things that help you can help a lot with your life are, meditating, eating well, going to the gym, taking those, releasing those emotions with something else. Okay, so this is only a reason because I want you to understand how you are as a person, especially. Not only me, but you. I want to know how you are as a person, but I want you to know how you are as a person. What's your biggest culprit when it comes to emotional decisions? What emotion is your biggest culprit? What emotion hinders you the most? Once you understand that, you can work with it. You can fix it. But definitely doing things to help you in your life, because when it comes to trading, your life is more important than that, right? And your life puts in, like, whatever you do in your life, how you are in your real life without trading comes into your trading life, in your trading career. So if you're a fat ass, right, if you eat like shit, if you're unhealthy, if you're lazy, all of that, if you don't work out, if you get pissed off all the time, if you have anger management or anger issues, if you're just unconfident in yourself, as a person, all of that will come into your trading life. It just does. So make sure that your life is perfect, like in terms of work on it to be as perfect as you can. Make sure that you're doing the best for your actual life, for yourself as a human being, before you even think about going into trading. If you eat like shit, if you're fat, lose weight, right? Eat better. Go work out, go on a run every day, whatever it is. If you're unconfident in yourself, gain that confidence back. Go out, do things. If you are nervous, go and do things that get you out of your comfort zone, get you a step out of your comfort zone. Go do that. If all of that, if you have anger issues, go to a class, go whatever it is. go to anger management class, whatever it is, do it so that you can become a better trader. Because if you're going in with trading with all these problems that you have, it's going to impact your trading a lot. And then after that, you understand who you are as a person and you fix that, you get better at it. You can add rules to prevent these factors from affecting your P&L or how much money you're making, your long-term P&L, right? Short-term does not matter. I say this all the time through this video. If you have a short-term perspective of it, you shouldn't be trading, okay? Go ahead and just gamble, I guess. But add these rules to prevent these factors, whatever is hindering you psychologically from affecting your long-term P&L. All right? So add in rules with that. And that's what I'm saying. Identify, acknowledge what problems you have psychologically, then add in the rules and try to fix it in any way you can. Because there's money involved in this, and you don't want to lose money, right? That's the whole point of it. There's money involved in this. You don't want to lose money in the long term. If you have issues over trading, and you go on edge after each loss, right? Or you wind up blowing weeks of progress in one day, all of that. Example, we can add a daily trade limit rule, right? You can only take these certain amount of trades, and that is your rule. That is the law. That is the holy grail. That is the law. Don't hinder from it. That already fixes your overtrading, doesn't it not? Let's say if you're revenge trading or something like that, add in a rule. Get out, go meditate. How about you go meditate? Go become happier with your life overall. That's a good rule to have. That's a good daily routine to have as well, right? But yeah, if you have issues, if you're too angry in a trade because you lost a trade, go get an anger management class. Go talk to family about it. Do something about that that'll make it better. If you're too over greedy, with trading, change your perspective of it. Add a rule and change your perspective of how you should be trading, right? I'm only gonna get change your perspective of how much money you should make in a trade, and then add in a rule. This is how much money I'm intending to make in a week, and I'm not gonna try to hit more than that. All right. If I make less than that, that's okay, but I'm not going to try to make more than that because then you're being over greedy. That could be a rule, a max limit amount of money you should be able to make in a week, right? That's your goal. Don't go above that if you like if it's a good goal, like let's say you want to make $500 in a week and it's realistic, don't try to go above that because you might just lose that, right? Or too greedy. How about you have a certain amount of trades per week as well? Like, don't go above that. That's all I'm saying. You can make these rules. You can add in these rules or daily routines if it's something more psychological, more emotional. You can add on all of this to make your trading better, right, and make you not lose as much money. Now, the discipline, like I said, I'm telling you, what if I told you the analysis part or the analysis portion is the easy part? I've said this before many times. It's the easiest part about it. The hard part is following your rules. And that's always hard. You don't want to follow your rules. You want to act on your emotions more. As a human, you tend to act on your emotions more. Especially when it comes to like women, I guess, but like that they act on their emotions more. But men too, we say that all about women. We act on emotions. Men act on their emotions too. It's just different emotions. We get angry easier than women do. We get more nervous easier than women do. And so all of that, it's hard because we act on our emotions a lot. It's hard to follow our rules. But what if I was told you will only be profitable if you follow your rules? Does that make you change yourself? Does that make you maybe think, oh, maybe I should stick to my rules, right? Maybe I should try my best to stick to my rules. You're gonna if you have a problem with sticking to rules and stuff like that, you're gonna have a little bit of a problem when it comes to trading. But if you can stick with it, right? If you can try to do your best every single day, every single week, you're gonna get way better at it, right? You might make mistakes, you might fall down the ladder a couple times, but just get back up on it, right? You're gonna fail sometimes, but if you just keep getting back up on it, you'll do much better. Next week goes by, maybe you messed up only once. The other week goes by, maybe you messed up only once again. But the other week goes by, maybe a month goes by, and you don't mess up at all that month. It'll get better overall, right? You're trying to create into a habit. So do that, and you can definitely get into a better aspect of or a better position when you're actually trading to become profitable, right? A lot of people know this. This is common sense at the end of the day, but they still fail to follow all these rules, and that's something that's going to be implanted in their head. Make it into a habit. Don't try to, if you ever like quit like drugs or whatever it is, alcohol, something that you do like a habit that's bad for you, you try to cold turkey it. It might work a lot, but most of the time people who do cold turkey go cold turkey and just completely quit whatever it is, they tend to go back from it again because they're quitting too quickly like that, and that always most of the time that never works. You have to be very, very disciplined, very disciplined. It's very rare to be that disciplined to just cold turkey from something. What actually works for most people is they try to do better each day, each week goes by, and they create a habit, right? So that's the only way most of you can actually follow your rules or become profitable enough to follow your rules all the time is by making it a habit, but knowing that you might fall down the ladder a couple times, knowing that you might fail a couple times. That's okay. Failure is a good thing. It shows you what to do right next time. So you're going to fail a couple times, but just keep getting back on it. And eventually, you might fail 5 times in a week, right? You might not follow your rules like 5 times in this week when you're trading. Next week, try to keep discipline. Try to only fail 4 times, right? You will fail 4 times, okay. Next other week, a month goes by. Try to only fail like 3 times, and then 2 times, and 1 time. Eventually, it gets to the point where you're not failing anymore. You're not failing from following your rules anymore at all. That will take some time, sure, but it's very hard because you're trying to kind of rewire how your brain is supposed to work, and that's the problem, because trading is trying to rewire a human brain. You're trying to rewire your emotions to not do these things, which in reality in every other part of life you would do the same thing. So just understand that once you have the analysis part of it, the analysis portion of it, you got the basics, you got the technical analysis, you got the setups, you got the strategy part of it, all of that, you got the analytical tracking of it, you're actually journaling your analysis of the setups of your trading plan, your risk to reward, your risk management, all of that. The hardest part comes after. Okay, that's the easiest part. Once you can do all that to the T, Now you got to talk about your psychological aspect of it, psychological tracking of it. Journal your thought process, journal your emotions, try to follow your rules, okay? All of that eventually, it'll be hard, it'll be a tough road, but eventually it'll come to it, all right? And accountability. I spelled that wrong. I'm not an English teacher, right? I'm a trader. I'm not meant to be, okay? I'm not meant to be smart at this kind of stuff. This is why you need to hold yourself accountable. I spelled that right, all right? Just so you know, I do know how to spell. This is why you need to hold yourself accountable. We will give you one daily goal. Follow your plan. That's it. That's accountability in the finest, in the fine print. Follow your plan. Accountability at its finest. All right. You should not care about losing or winning any trades because it's going to be random. It's probability. Probability is random at the end of the day. You don't know when you're going to lose. You don't know when you're going to win. But following your plan will lead you to make money in the span of 20 and 30 trades, in the span of 100 trades, all right? It's not a trade-by-trade basis. You're going to win a trade, you're going to lose a trade. You're going to win another trade, you're going to lose another trade. You're going to win a trade, you're going to win a trade, you're going to win a trade, you're going to lose a trade. All of that is probability, but it's random, okay? It's random probabilities. So don't care about losing or winning, just follow your plan. If your plan is set up by you backtesting and being analytical in terms of looking at the past history, you paper trading for 100 trades, whatever it is, you have a plan, it works 70% of the time. All right, so why are you caring about losing or winning those 70%? You're gonna win 70% of the time. Why do you care about the 30% that you're losing? It doesn't make any sense to me. So, but it doesn't make any sense to me now. It did beforehand. I'm telling you, I know all this from experience. Everything you're going through as a trader, every bad part of it, every failure you've done, trust me, I've done. Okay, trust me. So you should only care about your following your plan, right? If you don't follow your plan, that's when you should be mad. That's when you should be sad. That's when you should be unconfident. But if you're just caring about losing or winning trades, you're doing it all wrong, all right? Care about following your plan. That's your goal. Have your goal for a month be that. Follow my plan. Don't take trades out early. Don't take a profit early. Don't move your stop loss. Don't have a modified take profit or stop loss. Journal. Follow your plan. Follow your setups that you have. At the end of the day, that's all you should care about. Do that for a month and see how better you become as a trader. Right? So accountability at its finest is just following your plan. And if you care about losing or winning anything, it's especially when it's in a way where it's just random, you're gonna end up going in a spiral, a downward spiral at that. So don't look at it as trade by trade because you're gonna win a trade. Like I said, you're gonna lose a trade. All of that. Look at it as 20 to 30 trades. Follow your plan in terms of the span of 20 to 30 trades, 50 trades, 100 trades. And then you're good, all right? You follow your plan. If your plan, you can still be profitable with a 20 and 30% win rate, I believe, right? Obviously, the risk-to-reward ratio is definitely skewed to the reward. You have to have like a 1 to 5 or whatever it is. You can still be profitable though, right? But it's not a trade-by-trade basis because you're going to lose a lot of trades. But your reward, if you put it to a certain point where you actually know your reward, how it should be compared to your risk, you're going to win on the long term. At the end of the road, you're going to win. All right. Understand that, and you can be much safer about yourself. It's probability. You're much safer by yourself if you just understand that's how it works. Okay. And the most important part of this, we're going to this, is back testing. You got to back test. Back testing helps you understand how your setup and strategy reacted to the market in the past time. So it's a very important aspect of it because you're not only looking at paper trading to see how your setup and strategy reacts to the market now, but backtesting can show you how it reacts to past market history, which will help for the future market history to come, because usually it all aligns pretty similarly, okay? So backtesting is very important. Record data. So when I backtest, I'll go back to a similar 4-hour market structure, and that's happening right now in this data. That's how the backtesting makes it a lot easier, is you're looking at your trades from past history, but you can also make it really nice and look at it from past history of when it looks similar to now's histories of now, okay, the market now. So yeah, when I backtest, I'll go back to a similar 4-hour market structure, and I'll look at it like, okay, I'm looking at it, how would it react to now? I'm not paper trading, I'm not looking at the market structure right now, I'm looking at backtesting previous historical data. So once I backtest, I'm going to do this. I'm going to structure it just like this, okay? This is how you guys should do it too. This is the best way to backtest, and I've literally researched this from countless times, months on end, to see how to actually backtest the right way. Pause when you start your daily analysis. For me, when I backtest, it's 7:30 a.m. It can be any time for you whenever you do your daily analysis. That's not a time where it's like it has to be this certain time, right? Anytime you want. But pause when you start your normal, natural daily analysis that you're going to do in the future. Draw your levels, make your plan. It's like any other day. Just draw your levels, make your plan. You know how to make a plan now, right? You know how to draw your levels. So do that in past history market data. Fast forward until it hits your level. Okay, then go back to normal speed, right? So draw your levels, make your plan, fast forward until it hits your level. So fast forward until it hits your take profit, whatever level, or sorry, fast forward until it hits your zone level, right? Then go back to normal speed. Then you want to find an entry, a stop, a loss, and a take profit. So at the end of the day, you want to treat it like you're actually trading like a normal day. You're trading a normal day, all right? So find an entry where you're gonna get into the trade. Find your stop loss where it should be, and then find your take profit. Then you want to fast forward. You don't need to be in that trade for that long. It's either going to hit your stop loss or not, or your take profit. So you don't need to be in that trade like it's a normal day. Just that's why backtesting is way quicker than paper trading, because you can actually just backtest and fast forward to the future. So fast forward, see where it hit. Did it hit your stop loss? Did it hit your take profit? Did it hit your entry? Repeat. Repeat. Find your other levels. Go back in another day. Go back, repeat, go to the next day, go to the other day after that. Stick at a certain point. What I would do, in my opinion, and what I would do, this is just what I've been doing, ever since now, is I've been finding previous similar 4-hour market structure, but I've also done different ones. I would first start with a similar 4-hour market structure, then I would waver off from that. Find a market structure where the market had a recession, right? The market crashed a little bit, or the market had like high highs, right? Like it was just going higher highs, higher lows. It was just creating all-time highs consistently, like it is now, basically, right? Find that, and then once you find that, you want to do all of this. You want to make sure it's a structure, right? You want to go back and find a certain week. Start on Monday. Do all of this, and then repeat the next day. All of this, and then repeat the next day, right? And you're swing trading. This isn't day trading as well, right? So when you're swing trading, put that in accordance. Look at the higher time frames and look at it. You're not going to trade every day. So Monday, Tuesday, Wednesday, you don't have to do that. Start like Monday, right? You look for a trade that you're going to find, and then fast forward until it gets to your level. It might take like a day or whatever, right, to get to your level, and then take that trade. It might hit in a couple days. That's what I'm trying to say. You're swing trading, so it's a more alignment for you. It's more aligned for you to actually be able to wait longer times for your trade to hit, or for you to find a levels. It's not like day trading where you're finding consistently in a 5-minute time frame. It's going to be a 30-minute, hour time frame, stuff like that. So do all this. Wait for your trade to hit. It might take a day. It might not. Swing trading sometimes doesn't hit hits in less than a day, right? It might take 2 days. Whatever it does, just find it until it hits your level, then repeat. Rinse and repeat. Rinse and repeat. So rinse and repeat. So look up for the next day. See if there's a level that'll hit for swing trade next day. But all your rules still have to be in place. Remember that. You have 3, or if you do the same rules as I do, you can always make it different. But for my rules, I have 3 trades a week max and 2 losing trades a week max. Remember those rules for that week. So even when you're back testing, and let's say you win one trade and it hits, so you look at it on Monday, and then you draw your zone and it pulls back, or it hits your level on Monday, and then you take the trade, then it hits your stop loss or your take profit. Let's say it hits your take profit on a Tuesday, right? So you have one winning trade, right? Let's say it was a big trade that you hit, right? So you can either stop with it, or you can find a really good setup, right, during that week. It has to be the best outcome setup that you can have. Then if it does hit, you take that trade again. Let's say it hits your stop loss, right? Let's say the first trade hits your stop loss. Say that, okay, then hit my stop loss. I only have one more trade to go to. I'm going to find a really good setup for this week. And if I don't, I'm not going to trade, but I'm going to keep fast forwarding until I find a nice setup. Let's say it hits this zone, right? Let's say it hits my supply zone, my demand zone. And then Wednesday goes by, it hits your zone again, right? Whatever zone you have. I'm going to take that. I'm going to trade on it. I'm going to trade. I'm going to do exactly like I showed you to do here. I'm going to pause. I'm going to draw my levels, make my plan. If your level's already drawn, I'm going to make the plan. I'm going to fast forward until it hits the level. Then I'm going to go back to normal speed. Then I'm going to find my entry, my stop, my stop loss, my take profit. Then I'm going to fast forward. Now, did it hit my TP? Did it hit my stop loss again? If it hit your stop loss again, what was my rule? 2 losing trades a week. I'm done. I'm not going to trade again. Stick to those rules when you're back testing, because then it will correlate to you when you're paper trading, and then it will correlate to you when you're actually trading real money. So all this is a structure that you should have to the T. This is the best structure you can have in backtesting. Trust me, I've researched this countless of times. This is how you should go about it. I'm telling you right now. I don't tell you a lot of times this is exactly how you should do something unless I actually mean this is the best way that I've seen in research for months when I first started out to backtesting. This is exactly the way to go about it. When you're backtesting for the best possible outcome and finding your best possible win percentage and win rate while backtesting, right? Find out how good is your strategy past history. And then paper trading is a completely different beast. You're going to want to paper trade 100 trades minimum, right? 100 trades minimum, especially swing trading. I don't care. If you swing trading, you're saying, oh, but I'm swing trading, so I'm not taking that many trades. With day trading, it's so much easier to get 100 trades minimum. I don't care. Swing trading is just exactly like day trading at the end of the day. You still want to find a correct win rate, correct win percentage for your setup and your strategy. So I don't care, all right? Do that. 100 minimum trades if you actually want to find your true win rate. That is literally all I have for you, right? Now you learn the structure of backtesting. Now you learn the structure when you paper trade. You know, paper trade is very easy. It's like you're actually trading real money, but you're not. So once you do your backtesting, once you take 100 trades or more backtesting, which again is way easier because you can fast forward. Once you do that, paper trade. Start to paper trade, okay? That's everything I can give to you is just start a paper trade with the plan you have, with the setups you have, with the strategy you have. If you want to, and I do recommend you because, again, I make millions of dollars in the market from an 80% or more win rate on my setups and on my strategy. Take all of this. Use it for yourself. Watch this video 2 times or more. Jot down exactly my setups and my rules. Jot down the strategies I have. Jot down my psychological rules that I have, right? Jot down, okay, journal every day, journal what I do, then paper trade. So first backtest all this, right? I don't just ask you to do this by paper trading just by leaving me. First do all this, read it, learn the basics, learn all of it, then backtest. And once you've backtested, go into it and actually go in paper trading with it. Do paper trading, trade simulated money with my strategy. Swing trade with my strategy, with my setup, with my rules, with my journaling. Do all of that, okay? See how well you do paper trading, 100 trades. And then once you see, okay, I'm profitable with the strategy, right? I'm doing good, I'm consistent. Then you get into real money. Get a real account. Go get a prop from that allows swing trading. Whatever it is, do that and you'll be well within becoming profitable in about a year or so, right? You can become profitable in 6 months or more. Sure, you're not going to make a shit ton of money. You're just becoming profitable. You have a 10K account, you're risking 1-2% of it. You're going to make 1 or 2%. You're risking 1-2%. You're going to make a certain percentage of it consistently, but it's not you're making $1,000, $1,000 all the time, right? You're wanting to risk a short-term amount of money of it. If you're only doing 1 or 2% of a 10K account, at the end of the day, you're not going to be doing that much. You're not going to be putting that much money in, all right? So you're not looking to make. Let's say you have a 5K account. Let's say you have a 1K account, which you can trade $1,000 in forex and commodities and stuff like that. A 1K account, you can do profits with futures too. You have a 1K account. You are not looking to put in $100 every trade, are you? No. So you're gonna make not that much money, right? A 1K account, you're not gonna make that much money, but you also have to risk a little bit more with 1K account at the end of the day, sure. And it's just about how risk aligned you are with the capital you have, right? Don't look to, if you have a 10K account, don't look to make 5K right off the bat like that, all right? That's gambling. You know, you might have a solid setup, a solid strategy. That's not considered gambling, sure, but you risking more than you should, that's considered gambling. So risk a little bit. Make $100 a couple days, right? Scale up a little bit. Make $200 in days in, days out with the swing trade. Make 300. Scale up slowly, and then you'll get to the point where you have a 50K account, 100K account, and then you're actually looking in at the real big money because you were consistent with your strategy. You don't start with a 10K account and grow it to a 50K account, 100K account just by gambling. You start it with consistency, okay? People that you've seen try to do that, and they said they made it that quickly. No, it's not true, right? It's just a lie. It's fake. They're not actually doing that. You need consistency to actually do that in a safe manner. So that's all I can give to you, man. I can give you everything. I just gave you everything I have. Obviously, there's much more to come in terms of psychological and the technical part of it, which I'll have way more videos coming out. Like I said, I have more educational YouTube videos to come that goes in depth of way more stuff, way more in depth. Absolutely, I will. I'll even have another course video coming up, soon this year, sometime later this year, about that'll be like 10 hours worth, even more than that. And I got a lot more to give to you, but right now I'm giving you everything you do need. You do need to know, and I have a lot more to give you after that as well. But yeah, I also have a free Telegram link in the description. All right, and it's everything there is free. I'm giving you my setups, ideas for the week. I'm giving you my trades that I'm taking for that week as well. Everything is free. I'm not looking for you guys to be signal bots. All right, I'm just looking for you to take my trade ideas, all of that. I'm giving you even more stuff like psychological stuff, daily stuff, in that Telegram as well. Everything you need to know, I'll be posting my YouTube videos in that Telegram, so you know exactly when I'm posting my YouTube video, when I posted my YouTube videos, everything like that. I'll give you some free sauce. I'll give you my recap. I'll give you everything you need, and everything you need from like a mentor, I would guess. Absolutely all for free, right? So that's what I said. This is the end, but there's so much more to come. So definitely look to click the link in the description for my free Telegram. And just subscribe for my YouTube video right now, because there's so many more videos to come. Definitely subscribe and definitely help a brother out, But yeah, so look for the link in the description, and make sure to follow the channel on the Telegram, and you're gonna look at a lot of ideas. You're gonna, especially if you're just starting out, you're gonna look at what a profitable and experienced trader does during the day or during the week, or an experienced swing trader, does during the week. And after that, more educational YouTube videos to come. You're gonna look at a lot. If you have any ideas of what YouTube videos you want me to do, any opinions of what you think I should do, feel free to put it in the comments. I look at all of them, and yeah, I will make sure to do my best to accommodate to those ideas that you have. Like if you want me to do more videos about the strategy part, the setups part, or more psychological videos, or if you want to do more daily in the life of me videos, whatever it is, let me know in the comments, brother. All right, let me know in the comments, and I will make sure to do my best to accommodate to that. But yeah, that's everything you need to know. Again, make sure you click the link in the description for the free Telegram, and let me know in the comments about anything you need from me, any questions you have. I'm here for you guys. Again, I am your free mentor and your free, profitable, and experienced millionaire mentor, just for you guys, so you guys don't have to pay any money for any kind of dumb shit that people are trying to charge you for. All right, peace.